It's very hard to see the U.S. walking away from Israel if the Iranians are mounting a massive counterattack.
This White House has been consistent. They do want to see a diplomatic approach.
A tremendous amount of damage has been done to Iran's ability to respond.
We'll have to kind of wait and see what that situation in the Middle East plays out.
You're more likely going to see people fade those geopolitical risk events rather than double down on them.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance and another week of risk roulette. Markets uncomfortably numb as fighting escalates between Israel and Iran, a potential oil shock, making the Fed's job that much more difficult when it meets on Wednesday. And U.S. President Donald Trump heading to the G7 meetings at a time when trade tensions and geopolitical risks are high. Right now, markets are on edge, but waiting to make more big moves after a more than 7% surge on Friday. Oil futures now down just slightly this morning. Stocks trying to look through the noise to find a reason to rally. S&P futures down from some of the earlier highs, but still up 0.4%. 10-year yields, bonds, arguably the most interesting space as yields continue to climb for a second straight session, even in the face of geopolitics. Coming up, someone with a lot to say about that, Kelsey Berro of JPMorgan Asset Management, as stocks try to rebound. And bonds, what are they doing? Terry Haines of Pangaea Policy as Israel and Iran enter a fourth day of conflict, and Steve Ricchiuto of Mizuho counting down to a Fed rate decision. We begin this hour with our top story, the conflict between Israel and Iran extending into its fourth day, stoking fears of a wider conflict. Joining us now is Annmarie Hordern from the G7 in Canada and Jumana Bersachi in Dubai. Jumana, I want to start with you. What's the latest overnight in this conflict that has been going on for now 4 days?
That's right, Lisa. So the conflict has been going on for 4 days. No signs really of things letting up. We have seen an intensification of strikes on both sides over the course of the weekend, with Israel over the last couple of days targeting key sites dotted around Iran, be they nuclear sites. One of the main uranium facilities, Isfahan, has been severely damaged per the latest assessment by the IAEA, a crucial part of the uranium enrichment process. But not just there. They've also been targeting key military sites. The Israeli army this morning saying that they've managed to take out about 1/3 of Iran's missile launchers. Those are surface-to-surface missile launchers, in addition to the number of casualties as well. On Friday, we spoke about the number of senior commanders that were taken out by the IRGC. That number has now extended to 6. In addition to those nuclear scientists, the total death toll, though, in Iran is now 224. As for on the Israel side, they have said that over the last couple of days, they have received almost 400 ballistic missiles targeted both at central and northern parts of Israel, alongside 100 drones. Most of those have been intercepted by Israel's air defense system, but some of the missiles did actually manage to penetrate through the system, causing significant damage, as you can see on those images there. And the death toll in Israel, per the latest figures, now sits at around 24. In terms of whether the off-ramp is coming, at this point, the rhetoric from both sides is still extremely hawkish. The Israeli Prime Minister, over the course of the weekend, reiterating that this is an existential crisis for Israel. They're going to keep going, keep striking at various sites around Iran. And from the Iranian perspective, the only potential avenue for de-escalation came from the foreign minister this morning, and he said that Iran would only stop their attacks on Israel should Israel cede their attacks on Iran. So no real signs of things thawing. And of course, one major other development over the weekend is that sixth round of talks between U.S. and Iran that were scheduled to take place in Oman were canceled. And the latest being some reporting suggesting, and this hasn't been confirmed yet, that Iran is seriously considering pulling out of the non-proliferation treaty, which would be one step further and would indicate that they have pretty much given up on the diplomatic angle to contain their nuclear enrichment program.
Yeah, and that's the backdrop right now for President Donald Trump. And Annmarie, he is heading over to Alberta in Canada for that G7 meeting. I believe he already got there after leaving last night. You are there on the ground. And the question now isn't so much how awkward is this family photo going to be that they're going to take, but even, is this a family anymore, Annmarie?
Well, when it comes to the G7, they are, and sometimes you have to have the toughest conversations with your friends and family. But to the point you're making, Lisa, is it's going to be very difficult for this group to find common purpose on a number of issues when it comes to potentially Ukraine. President Zelensky will be here, things like climate. But then, of course, this meeting will now be overshadowed by the conflict in the region. What is going on between Iran and Israel? Could we see a statement of unity from the G7? You have individuals like President Emmanuel Macron speaking yesterday, talking about the fact that he wants to see de-escalation, saying the United States could be the partner that brings everyone to the table. But Trump has kept his options open, really, if you read between the lines on some of his statements before departing the White House and heading here to Canada. He talks about how basically both parties need to fight it out, but he thinks there'll be a deal in the end, maybe giving Israel some time to continue going after those nuclear facilities. And then he told ABC News, we're not involved in it. It's possible we could get involved, but we are not at this moment involved. He left the path open for U.S. involvement. The U.S. would get involved potentially in Iran. There's a growing question if they were trying to strike the Israelis, one particular nuclear facility, Fordo, which is buried deep into a mountain. At the moment, the United States has not been involved except for the defense of Israel. This is going to be the topic that overshadows this G7 meeting, even, Lisa, when you have the likes of South Korea here, Mexico here, and other countries that came to hopefully also strike trade deals on the sidelines.
Annmarie Hordern, Jumana Bersetchi, to both of you, thank you so much for that reporting. Right now, let's get the view from Wall Street this morning. Joining us now for the hour is Kelsey Berro of JPMorgan Asset Management. Kelsey, good morning. How much do you look at everything that's going on and say that markets should be responding more than they currently are? Because what we see right now is a level of let's take this in stride, let's not overreact. We haven't seen the disruption to oil supplies in a massive way just yet.
Yeah, I think you hit the nail on the head in terms of the reaction has been rational. It's been muted, particularly in emerging markets. We've seen the price action is very contained to the areas of interest. You know, when I think about the implications of the tensions in the Middle East, I think of two very important parts of the macro landscape. One is oil and two is the dollar. And the themes for this year have been stable to lower oil because supply is plentiful, and it's been a weaker dollar. And the question was, as the headlines emerged around the Middle East and the conflict between Israel and Iran was, are those trades going to be disrupted in any way? Oil because of a risk of supply, the dollar because of that safe haven, does that start to reverse? And I think what we've seen is there was maybe a temporary concern around those. We've seen a repricing in oil higher somewhat. We saw some temporary strength in the dollar, but both of those seem to have stabilized here. And, you know, our view generally has been that we are going to expect a weaker dollar this year and that the oil market is well supplied.
Hold on a second. Let's unpack some of this because there are a lot of aspects to what you just talked about. Putting oil aside, this idea of the disinflationary shock, which we'll get to in just a second, and whether that's durable in the face of some conflict that we've been seeing in the Middle East. The dollar is weakening again today. We are seeing that versus the euro. We are seeing that across G10. There is a question about whether the lack of the dollar's ability to rally is a real question about the haven status of the United States, especially when paired with the sell-off that we've seen in treasuries for 2 straight sessions, including on Friday. Why do you not say this signals that there is a very different mechanism right now in U.S. markets where classic havens no longer act as such?
Yeah, so I think we are at risk of maybe reading into the price action of the last 2 days, maybe a little bit too literally. So, you know, when I looked at the move higher in yields on Friday, to me, what stood out to me was not the fact that, you know, U.S. Treasury yields were moving higher, but the fact that it was a global move. So boons were moving higher, gilts were moving higher, oats were moving higher in yield. Now, if you were to tell me that there was a safe haven demand on Friday that wasn't being met by Treasuries and people were piling into something else, well, I'm not sure what that something else was because the U.S. was actually outperforming on a relative basis, meaning Treasury yields were rising less than they were throughout the rest of the world. Now, I also do think that you need to differentiate, though, between the de-dollarization trend as it relates to asset allocation and also hedging strategies. So what we've seen is that investors, foreign investors, are holding on to their dollar assets. They see value in those dollar assets, but what they're doing is they're reevaluating their hedging strategy. So they're taking a portfolio that may have been 20 or 30% hedged back to their home currency, and they're hedging back a larger percentage of that portfolio.
Okay, that said, there still is this remarkable incidence that we're seeing right now in bond markets. The fact that on Friday, which was a massively risk-off day, the fact that we saw oil prices surging and we saw stock prices falling, the fact that people were talking about how this was going to potentially, you saw RBC this morning, cause a 20% decline in equities should it prolong and should it end up escalating in any kind of way. To not see long-duration bonds in the United States rally, maybe it's a global trend, but doesn't that change the equation if developed market bonds no longer provide that counter-cyclical hedge against some sort of risk-off event?
Yeah. So I think what we need to differentiate is the type of shock that treasuries are hedging and where on the curve is best to position yourself for that shock. So the shock that treasuries and high-quality fixed income best hedge for is a negative growth shock. Now, I don't necessarily think that you can translate the tensions in the Middle East to a negative growth shock. If anything, the biggest direct first-order impact is inflation, which is the number one enemy of fixed income. Inflation is the type of shock that bonds can't hedge against. But the things that I learned over the last week in terms of economic data, to take it back to the inflation report and the CPI report we got last week, is actually that we're seeing disinflation among a number of different categories. And that when we did see that, we did see bonds rally.
Okay, in fairness, though, for Wednesday, when the Fed meets in Washington, D.C., how much does this push off the potential for any sort of rate cut, given the fact that not only do you have the potential ramifications from tariffs, but you now have the potential for an oil shock that, yes, long-term could be deflationary or disinflationary, but short-term, very direct hit to some of the progress that we've been making in CPI?
So I don't think that you can expect much from the Fed this week. I think there is an argument to expect the dot plot to perhaps show one less rate cut in 2025 and move that into 2026. That's just a function of what I'll call time decay. Yeah, there's only 6 months left in the year. But what I actually think that they're going to do, and this is a close call, is they're going to keep everything the same. They're going to upgrade inflation. They're going to downgrade growth. They're going to say these things are all still offsetting. We can't make a judgment yet about what's going to happen yet next. And so let's just keep it all the same. That is the path of least resistance. But if you're in a world where the Fed is on hold, but the bias is to cut, I see yields as range bound around here. And that's basically the price action we've been seeing. There's been volatility day to day. If I look over the last week, 10-year yields maybe a couple basis points lower than they were, but essentially unchanged.
Kelsey Berro of JPMorgan Asset Management will be sticking with us for the hour, which is a good and beautiful thing right now. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Good morning, Lisa. Fighting between Israel and Iran is now in its fourth day. Iran fired several waves of drones and missiles over the last 24 hours, while Israel continued hitting the Islamic Republic's capital, Tehran, killing another senior military official. The Iranian government says 224 people have been killed, while Israel says Iranian attacks killed 23 people and injured more than 400. Meanwhile, China's retail sales beat estimates, rising 6.4% in May. That's the fastest pace since December 2023. The strong consumption may have been boosted by an annual shopping festival and government subsidies for home appliances, though economists warn it may not represent a turnaround in sentiment. And Nippon Steel shares rose in Japanese trading after President Donald Trump approved its $14.1 billion purchase of U.S. steel. Nippon has been keen to add the U.S. business to help offset its declining sales in Japan. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, hoping for a deal.
Well, I hope there's going to be a deal. I think it's time for a deal, and we'll see what happens. But sometimes they have to fight it out, but we're going to see what happens. I think there's a good chance there'll be a deal.
Coming up next, we're going to be speaking with Terry Haines of Pangaea Policy to understand the likelihoods and the contours of what that deal could look like. This is Bloomberg. Starting the week trying to move on from the geopolitical risk over the weekend that really is causing concern among some pockets. Right now, markets not showing it too much. You're seeing S&P futures claw just a little bit higher off some of the earlier highs, but up about 0.5% on the S&P and the NASDAQ. What you see in bonds is actually interesting because it is the second straight day of yields rising, bond price down in the long space in particular ahead of that 20-year auction later today. 30-year bonds up almost 3 basis points, same as 10-year yields, after also rising on Friday, 443 for the 10-year. Meanwhile, in the oil space, trying to get some sort of rally, sense of a bid into oil. On Friday, we saw a 7% rally. Today, we're taking off some of that risk, but just still up about 6% overall from when this conflict first ignited. Under surveillance this morning, hoping for a deal.
Well, I hope there's going to
Here's the latest. Well, if we can get you that sound in just a bit, a fourth straight day of attacks between Israel and Iran, stoking fears of a wider war. At least 23 people have been killed in Israel and over 220 in Iran. This as world leaders, including President Trump, gather at the G7 summit as the conflict shows no signs of easing. Bloomberg's Tyler Kendall joins us now. And Tyler, let's just start with what the U.S. response has been. President Trump has talked about looking for a deal, but also has raised the prospect of the U.S. possibly entering the conflict against Iran, especially should any U.S. troops get attacked. What's the latest in terms of the D.C. response?
Yeah, hey, Lisa, good morning. Well, we know U.S. officials in Washington have been in close touch with their Israeli counterparts as this moves forward. And even as you've been discussing, though, there's been very little indication that either side, Israel or Iran at this moment, is looking to de-escalate the conflict, even as President Trump has said that they should and ultimately they will. Now, as you mentioned, the U.S. has helped Israel defend itself, but at the moment has yet to move to that point of going on the offense when it comes to these ongoing strikes. But we have seen sort of a renewed public pressure from Israeli officials, including Israel's science minister over the weekend, calling on both the U.S. but also European allies to help them when it comes to the offense. Of course, this is going to take center stage during the G7 summit this week in Canada. But we should note that President Trump had a phone call over the weekend, not with a G7 ally, but instead with Russian President Vladimir Putin. And President Trump said that he would be open to the Kremlin potentially mediating talks between Israel and Iran. And we should, of course, note the context that Russia is a strategic ally of Iran, but it all comes amid the broader geopolitical backdrop that the White House is contending with here, including the ongoing war in Ukraine. Now, no matter how the U.S. gets involved, President Trump has made it clear that their message to Iran is not to retaliate against any U.S. personnel or interests in the region. Of course, this is going to be very important moving forward, and it's something that congressional leaders have highlighted as well, Lisa, including Senate Majority Leader John Thune, who also in an interview over the weekend suggested that Iran had become, quote, defiant when it comes to the nuclear talks. Of course, this would be the diplomatic off-ramp here if that is still on the table. Our analysts at Bloomberg Economics say for now it doesn't look like that's going to resume anytime soon.
Tyler Kendall of Bloomberg, thank you so much for the reporting. Joining us now, Terry Haines of Pangaea Policy. And Terry, I just want to start there. How likely is it that the U.S. gets involved in a more material way in a conflict that a lot of people are waiting and watching with bated breath to see whether or not it escalates?
Well, good morning, Lisa. And it is, I think the likelihood is low. I don't think it's vanishingly low, though. And the question basically involves what kind of assistance we would provide under what sort of circumstances. That seems obvious, but I just want to say that to make clear that we're not talking about troops on the ground here. I think what we're talking about is whether or not there might be air or sea support in any sort of operation. But we are, to emphasize your theme this morning, we're in the very early stages of this, and both sides are very much in a I win, you lose sort of posture. And as long as that's the case, this is a particularly difficult situation, and not like the other ones where risk was easily figured out by markets pretty quickly.
Well,
not like those things at all.
Especially, Terry, because there's sort of this lack of clarity around what President Trump wants to do. He's been saying that he doesn't want a new war. He doesn't want to start one. He doesn't want to be involved with one. How much is sort of the split opinion within the MAGA base, within a lot of the Republicans and, frankly, the Democrats, the reluctance to get involved, complicating a lot of this calculus?
I think the domestic politics are overemphasized here. What's gone on here mostly is a situation where I think Trump's hesitancy, rhetorical hesitancy, gets overemphasized. We are still providing a lot of support in Ukraine, for example, more than we had before. We're providing a lot of support for Israel. We're trying to ring fence in Taiwan to make sure that they're supported. Trump certainly doesn't want to be in a war, go to war, but at the same time, we are still pretty interventionist across the board here. So I don't think there's going to be any hesitancy on Trump's part in providing assistance to Israel should she need it.
Terry, if I could take a step back here, it feels to me like the administration's focus is very stretched right now in a number of different directions, both domestic agenda, international agenda. Where do they focus their attention this week? And do we risk taking a step back in terms of progress on trade or on the economic objectives because of all of this noise?
Good morning, Kelsey. And I think the answer is yes to all of those things, frankly. This is an administration that is stretched, but it's stretched in part by design as opposed to events. And what they see is a situation where the economic policy of the United States is essentially being in service to geopolitics very explicitly. And what they see is a situation where over the next few weeks, what they want to do is they want to wrap up the tax bill, which provides a growth boost, puts the United States in a better position. Their view of this. At the same time, they continue to want to conclude trade deals and continue to negotiate on those fronts. And finally, they're supplying aid and comfort to allies, and trying to negotiate a couple of conflicts. So this is a situation where the geopolitics, of course, is pressing on the Trump administration, but at the same time, what they've been trying to do is address that geopolitical situation, both in the traditional sense and by using economic policy to bolster the United States position.
Terry Haines of Geopolicy, thank you so much for that insight. I'm sure we'll catch up with you soon. I am wondering, Kelsey, I'll turn that back on you in terms of where the focus is for markets and how this affects the market's view of any progress or not on both the tax bill as well as what we're seeing with respect to trade negotiations.
Yeah, so, we have the G7 happening at the same time, and obviously the deadline of July 9th for the trade negotiations is looming large. Also, the deadline of July 4th, which is the self-imposed deadline by the Congress to try to get this one big, beautiful bill to the Trump administration, to Trump's desk, so they can get it ahead of the August potential X date for the debt ceiling. So there really is quite a lot that the market needs to be focused on. I'd probably say the one that is potentially to provide bigger surprises this week is maybe on the tariff side rather than the one big beautiful bill. I don't know if we're going to hear a ton on that. We kind of, at least at this point, have a sense of the big picture. The CBO has given us the scoring. We can now look at it. We can compare it to the amount of tariff revenue. We can estimate the growth impulse. I think on the tariff side, there's still a lot of kind of uncertainty about, we have an effective tariff rate now of 14 to 15%. Is the risk that it's going lower, or is there a risk that it actually could still go higher from here?
That's the reason why we're playing Risk Roulette, and we'll continue playing Risk Roulette throughout the week. Coming up next, we're going to be speaking with Aaron David Miller of the Carnegie Endowment for International Peace to understand the contours of the conflict between Iran and Israel and what the off-ramps could potentially be. Interesting right now, markets trying to shrug it off with equity futures rallying just a touch into the open. This is Bloomberg Surveillance. into a new week with the eyes squarely focused on the Middle East, the rising conflict between Iran and Israel, with a question of what is the off-ramp. Right now, equities are trying to stage some sort of rally after selling off on Friday in response to this geopolitical issue. You're seeing NASDAQ futures and S&P futures both up about 0.5%. You're seeing bonds selling off for the second straight session, and you're seeing the dollar weakening versus the euro as maybe there's just a tinge of a risk on feel. 3 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We start with U.S. Steel. Those shares are rising 5% after President Trump greenlit Nippon Steel $14.1 billion takeover of the U.S. company, a deal he once opposed, but with major concessions, including a golden share and $14 billion promised in U.S. investments, Trump got on board. As a result, this will create the world's second largest steelmaker. Next up, we have shares of Sarepta. Those are moving in the opposite direction, down more than 42% now in the pre-market on some tragic news that a second patient has died after taking its gene therapy for a rare muscle disorder. As a result, the company halted trials and paused shipments of the treatment called Elevides. The news has spurred a number of downgrades by Wall Street analysts. And ending on a more positive note, we have Cisco. Those shares are rising 1.8% after getting a boost over at Deutsche Bank, which upgraded the stock to a buy. The analyst saying that he sees steady growth ahead for years thanks to AI. And he also says that its expansive supply chain will help shield it against tariffs. Deutsche Bank now has a $73 price target on this stock, which is about 12% higher from here. Lisa?
Thank you so much, Yahaira. On our radar this morning, the conflict between Israel and Iran entering a fourth day with no sign of easing. Tensions erupting into full-blown conflict on Friday. Israel continuing to attack Tehran while Iran fires drones and missiles, some of which have gotten through. Kelsey, what has struck me, and we're going to put aside the geopolitics, we're going to get into just the strategy and what's going to happen and what the potential off-ramp could be. I am curious about the ramifications for oil and how you view that as a market risk at a time when potentially this was one of the tailwinds for disinflation that we've seen so far this year.
Indeed, it has been a tailwind for disinflation. It's been a mixed bag as it relates to, for instance, emerging markets, where you have about 50% of the market being oil importers and 50% being oil exporters. But it's undoubtedly been a nice tailwind for the U.S. consumer and something that the Trump administration can hang their hat on. I think more broadly, when our analysts look at the demand supply picture within the oil markets, we generally feel that the market is fairly well supplied. And, unless we're seeing a real concern in terms of supply disruptions to the major oil producers, so, we're thinking about Saudi Arabia, Russia, there's generally, a fairly good balance there where OPEC can step up and has been stepping up to improve the supply-demand picture and keep the oil price on balance.
Which is part of the reason why maybe you're getting a little bit of a dip right now in oil prices as people take a look and say it doesn't look like the Strait of Hormuz is going to get blocked off. So it seems like maybe this isn't exactly the state of permanent affairs. Meanwhile, President Trump looking for some sort of response as he arrives at the G7 meeting in Canada amid two global hot wars, as we were just talking about, and trade negotiations hanging in the balance. Trump saying Israel and Iran may need to fight it out, while other world leaders call for both sides to avoid escalation. And Kelsey, you asked a great question earlier. This idea of how much what's going on with those Israel and Iran takes away some of the attention for some of the other issues that we've been focusing on. And you pointed to trade in particular and how that's really become something of an increasing risk for markets.
Right. So, we're sitting here with an effective tariff rate around 14 to 15%, and there's still a lot of uncertainty about the direction from here. So on one side, we're heading into the G7. There's a number of countries that maybe can negotiate lower tariff rates or prevent the tariff rate from going up on July 9th. On the other hand, we've been watching in the background, they've been setting up to do many more sectoral tariffs. And those could actually bring the tariff rate in the other direction. So, I would say in general, that's an area where there's a fair bit of still two-sided risk. And when I think about the inflation report last week, and I see the disinflation in services, that's something I expect to stay. I think that's an indication of the weakening growth prospects underneath the surface in the U.S. economy. Where I do expect we're still eventually going to see that inflation is on the good side. The tariff impact is showing up. It will show up in inflation in specific categories within goods.
So this is really going to be what a lot of people are watching and parsing through as we get additional inflation reads. Meanwhile, of course, there's also the bill negotiations and this question of whether the tax bill will pass and how much it will increase the deficit. Senator Rand Paul signaling he's willing to negotiate on Trump's big, beautiful tax bill, as other GOP hardliners also appear to soften their stance, with few willing to go against the president on one of his biggest priorities. We'll get into that later in the show. We do want to turn back to the conflict in Israel and Iran. Attacks continuing on both sides. Bloomberg's Ethan Bronner joins us now from Tel Aviv. Ethan, can you just paint a scene in terms of the damage that's been done and what the public sentiment is about continuing this war?
Sure, Lisa. There's been several hundred missiles that have come here and a whole bunch of forays since Friday late evening. The most recent was this morning here, Monday morning. And they do enormous damage. They weigh 1,000 kilograms. It's like a school bus filled with explosives falling on a building. There have been in Israel 24 people killed, about 400 wounded. And of course, there's also huge damage and killing on the other side in Iran.
That's the reason why I think a lot of people are looking to see how really this conflict can end or what kind of off-ramp to de-escalate there is. Bloomberg's Ethan Bronner, stay close. We're going to be catching up with you later on. Right now, Aaron David Miller of the Carnegie Endowment for International Peace joins us. Aaron, I just want to get your sense of how realistic it is for the calls for de-escalation to actually resonate with either Netanyahu or with Iran at a time where both of them seem to be really digging in.
Great question, Lisa. Thanks for having me. I think it's completely unrealistic and detached from the current reality for three reasons. The Israelis want to destroy as much of Iran's nuclear program as possible, but they're going to have a very difficult time doing it. And they have escalation dominance and air superiority and political superiority. There's absolutely no pushback from anyone in the region, in Europe, from the United States, from the Trump administration, for the Israelis to stop. As one Israeli general put it, retired, we're playing soccer with the Iranians, but they have no goalie. The Iranians, having invested $5 trillion in this nuclear program and having been embarrassed and humiliated to a degree that is unprecedented probably in the history of the Islamic Republic, are not going to yield on this. How deep their ballistic missile inventory is, 2,000 to 2,500 ballistic missiles. They can keep this up for some time. And the Americans, I think, Trump administration is faced with a dilemma. He does not want to enter this war, but he cannot stop it. It reminds me of Lyndon Johnson's description in the Vietnam War of a hitchhiker in a Texas hailstorm. I can't run, I can't hide, and I can't make it stop. Question for Trump, for all of us, I'm not sure Trump wants to make it stop.
Well, that's actually something he's hinted at, this question of maybe they have to fight it out and just complete it from that perspective. What is the ultimate goal, though, Aaron? I mean, given the fact that you just said that, as one general told you, Israel is playing soccer and Iran has no goalie, what's the ultimate aim? Is it regime change? How do they achieve something that actually can be sustainable for the entire region?
I mean, critical question. Had you told me on October 8th that 18 months into the Israeli-Hamas war in Gaza, there will be absolutely no sign of this conflict abating, I would have said you're a bad analyst. The fact is, the prime minister in Gaza has identified total victory as a goal. I think what he would like to do, his aspirations, would be regime change on one hand, and number two, deploying the United States, if he can, to do what the Israelis cannot, which is to destroy Fordo and really make not a dent, but a major crippling of the Iranian nuclear program, which would set it back at least 2 years. So I think right now there's no reason for Netanyahu to stop. Ballistic missiles in Israel are very problematic. I mean, the Iranians are launching maybe 10 to 15% are actually getting through and striking, but you've seen, Ethan reported, you've seen some of the damage, 24 Israelis killed. I think the public will endure this for quite some time. So right now, I see absolutely no way, no off-ramp, no possibility. And then you, of course, raise the question is what, in fact, would a negotiation, other than cessation of hostilities, what would a negotiation between the United States and Iran produce? 2 months of negotiations produced an impasse. And I think the Iranians are in no mood, frankly, right now for compromise.
Aaron, I hear you saying that there is not a likely off-ramp in the near term, but for investors, what can we watch to look for any signs of de-escalation or escalation from here? You know, what are the key points that you are looking for?
Right. I mean, de-escalation, I think, right now is not in the cards. I think there's a really good chance that we'll be in for weeks of this. It's the escalatory possibilities that concern me. And this is your guys' business, not mine. Would concern investors as well. And escalation, I think, could occur in one of two ways. Number one, Iranian ballistic missiles actually end up surging, and you end up with a mass casualty event in Israel. Hundreds of Israelis are killed or wounded. The Trump administration, under those circumstances, Congress, are going to be hard-pressed, I think, to enter the conflict. And the second path to escalation, or maybe there are three. Second path to escalation would be a bad decision on the part of the Islamic Republic to go after American assets, U.S. forces in Iraq, Syria, or obviously forces 30 to 35,000 Americans that are deployed in the Gulf. And they have many short-range ballistic missiles, thousands of them, that could produce that. The third possibility is that the Iranians try some sort of asymmetrical strategy in which they go after Israeli interests abroad, Jewish interests abroad in a terror attack. I think that's a back door that would also probably bring in the United States. But again, we've watched over the course of the last 18 months, we've steered clear of the one thing that investors worry about, the one thing I would worry about, the one thing the region worries about, and that would be a major regional war. We've avoided that. This is bringing us, or the longer this goes on, the greater the chances of an escalatory cycle and an Iranian-Saudi conflict and a U.S. conflict, which would essentially push oil prices probably well in excess of $100.
Aaron, just quickly here, one thing that the market keeps focusing on that could catalyze that kind of regional war would be shutting down the Straits of Hormuz. How realistic is that, given the fact that would anger everybody in the neighborhood?
I mean, the Iranians could probably close it, and the Americans would definitely open it. But again, we're talking about a prolonged delay filled with uncertainties, all sorts of exit ramps of an unpleasant nature that is going to make this extremely unpredictable.
Aaron David Miller of the Carnegie Endowment for International Peace, thank you so much for the insight. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. The man suspected of killing Minnesota Democratic state lawmaker Melissa Hortman and her husband, Mark, is in custody. The FBI had offered a $50,000 reward for information leading to the arrest of 57-year-old Vance Fulcher. 2 other people, including a state senator, were also injured in Saturday's shooting. Meanwhile, shares of Kering are surging in European trading. The owner of the struggling Gucci fashion label is preparing to name the CEO of Renault as its next chief executive in a bid for a turnaround. Sources telling us here at Bloomberg, Luca De Maio will be appointed to the job in the coming days. Meanwhile, shares of Renault are trading lower in Paris. And another activist investor is seeking changes at Victoria's Secret. Sources telling us here at Bloomberg that Barrington Capital Group, which has built a stake in the lingerie retailer, plans to push for a board overhaul. Earlier this month, one of Victoria's Secret's largest investors, BBRC International, also called for major board changes. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahaira. Up next, the Fed's inflection point.
We're now at the inflection point. It's very difficult to gauge what the outlook is going to be under different circumstances, and as a result, what the Fed's reaction function is going to be.
Steve Ricchiuto of Mizuho joins us next as we parse through some of the fundamentals of the U.S. economy, and frankly, that have been really interesting. This is Bloomberg Surveillance. It is Fed week. It doesn't feel like Fed week because the focus seems to be squarely elsewhere as we play risk roulette. Right now, we're looking at a bond market where yields are up for a second straight session, even in the face of a major conflict between Iran and Israel and a potential threat to the entire Middle East region. Right now, you're seeing 10-year and 30-year yields up 3 basis points, 4.43%. Under surveillance this morning, the Fed's inflection point.
We're now at the inflection point. We're going to start to see stronger inflation as a result of the tariffs feeding through. In this environment that is highly volatile, where you have tariffs, where you now have the potential risk of higher oil prices, higher financial market volatility, tightening financial conditions, it's very difficult to gauge what the outlook is going to be under different circumstances, and as a result, what the Fed's reaction function is going to be.
Here's the latest. The Federal Reserve's two-day meeting kicking off tomorrow. The FOMC widely expected to hold rates steady, but update its economic forecast, giving markets a clue about how officials will handle tariffs, inflation, and more. Joining us now for that potential scenario analysis is Steve Ricchiuto of Mizuho. Steve, great to see you. Thank you so much for being here. Just before we get into what the Fed does, I want to bring you into the debate that Kelsey and I were having earlier. How important is it that in the face of risk on Friday and today, you are not seeing bonds, full faith and credit, rally?
I think there's a number of things. People have questioned the dollar's reserve currency status. People have questioned a lot of interesting information about where people are going from a global perspective in terms of investing in the United States. The reality is we haven't seen much. Okay, so yeah, the dollar is down a little bit, but on a DXY basis, it's still very, very healthy. Under Joe Biden, we were at 90 on a DXY basis, and we're talking about 97, 98 now. What's the big deal? The reality is when you look at most markets, there's very little impact of anything. And I think this goes to the fact that there is no systemic risk in the economy. There is no balance sheet related risk. There's excess liquidity. There's excess global savings. And there's a lot of oil floating around in the world. And I think when you put all of that together, you can easily see why markets are just sitting there saying, OK, we've tried to sell off several times. We've tried to rally several times. We've had 8 recession calls since 2022. None of them have worked. Let's just get on with life.
So you're essentially describing a bit of an equilibrium where everything is just kind of at this steady state. And so that gets me thinking about this concept of the neutral rate, which the Fed estimates in the dot plot, and they're going to do another crack at that. That neutral rate has been ticking higher. It's about 50 basis points higher over the last year, but the Fed still thinks that the current level of policy is restrictive. What do you think?
I don't think the current level of policy is restrictive, haven't for quite some time. I think the Fed rate cuts last year were a disaster. I think trying to repeat that again this year would be a bigger mistake. I think when you look at a 2% real greater growth in the economy, an inflation rate that's running about 2.5%, you're looking at 4.5% neutral rate from a nominal Fed funds rate perspective. And to me, where are we right now? 4.5%. I think we should be ending the year closer to 5% because I think inflation will be 3%. And I think the only reason why you haven't seen inflation from tariffs coming through is because in this environment, while there's negotiations going on, a lot of CEOs are sitting there saying, I'm not going to be the first one to move to raise prices because I don't want to lose market share. I pre-inventoried a lot of stuff. I've got time. I've got opportunity. Let's see how this plays out before I make any decisions.
Well, we would certainly agree with you in terms of the inflation assessment. We also took a look at that and said, yeah, I mean, you're not going to get negative goods prices month over month on a persistent basis. But I do want to kind of drill into this idea of Goldilocks and how long it can persist, this equilibrium, particularly on the labor market side, because what caught my eye last week was continuing claims, which continue to rise. Just those cracks under the surface. Do you see those as a concern? Is there anything there for the Fed to be worried about?
Claims and continuing claims on a 4-week moving average are at exceptionally low levels. When you look at them at covered employment, they're even at a lower level. There's no risk whatsoever in this labor market, and I think that's the key. I think if you're looking for one market where there's potentially a movement out of equilibrium, it is the labor market. But that is only a move towards a tighter labor market. Okay, once you get this tax cut done, and this tax cut I think will be bigger than anyone still currently thinks, I think you'll wind up seeing with a much tighter labor market and a much greater push on inflation. And therefore, I question whether or not the Fed's going to get the so-called 2 rate cuts out this year.
So you think that maybe the Fed's not going to cut? Is that kind of your call?
Our call has been the Fed shouldn't cut whatsoever, and therefore we believe the Fed won't cut.
So there's a question here about longer-term bonds and how that really bleeds through at a time when people have not seen this as a haven. And there's been a real question about the inflation risk being priced in or not. And I'm just wondering, do you see yields going higher from here with questions about U.S. assets as a haven, as well as potential inflation that's only exacerbated potentially by inefficiencies and oil shocks that might come up along the way?
I mean, I think we're supposed to get to 5% on the 10-year note. I don't think that's a disaster. When you look at what's happening in the BOJ market, for example, they're having a significant amount of problems there as yields rise in Japan. You look at Europe. European rates probably aren't going to go up because Europe's a mess. And Christine Lagarde doesn't think she needs to cut interest rates, and she does. So I think you've got this situation. Well, I'd rather buy Europe because Europe's more likely to go into deflation than buy the U.S., where we're likely to have 3% inflation. So I don't think we have to get beyond the macro into this geopolitical concern about, solvency and sovereignty and all this other garbage and reserve currency to explain what's happening in markets. What's happening in markets is you're reflecting relative interest rate differentials based on relative inflation differentials and relative real growth. And there's nothing that's mysterious about this. It's traditional macroeconomics.
So we're continuing to work through one big, beautiful bill that's going on underneath all of these headlines that we've been dealing with. And I was curious, the way I think about deficit expansion is there's deficit expansion and then there's fiscal impulse. So some of the improvement or deterioration in the deficit is a function of just extending the tax cuts, which isn't necessarily a fiscal impulse. How do you differentiate between the two? And you mentioned already that you see the risk is actually to more fiscal impulse and more deficit expansion from here.
Yeah, no, I agree with you. I mean, if you were just going to extend the tax cut alone, you would not have a major positive impulse into the economy. But we're not going to do that. And I think the interesting thing is all this stuff is going on and the bill is working its way through the system without the news oversight to it that it would normally deserve to get. And this is what happened when suddenly the House passed the bill. Okay. When it came out of committee in the House, suddenly people woke up, oh my God, it's not just extending the Trump tax cuts. And I think, this is part of the process. It's how the bill is getting done as quickly as it is. And I still think their game plan is to get it done by July 4th and have it implemented by October 1 so they could have a full year of real tax cuts coming through the economy going into the November elections. And I think that's the game plan here. I think the game plan is tariffs are the diversion to get the tax cut. Tax cuts are the reason to get the midterm. The midterm is to get to what they really want to do, which is drain the swamp.
Well, this is what we're going to try to focus on as we parse through all the different risks that are coming up and dominating the news. Steve Ricchiuto of Mizuho, thank you so much for being with us. Kelsey Berro of JPMorgan Asset Management, thank you so much for being with us for the full hour with some fantastic insights as markets shrug off a lot of risk, try to get some sort of rally underway. Coming up next, we'll parse through that with Dan Skelly of Morgan Stanley, Henrietta Treyz of Veda Partners, Riyadh Air CEO Tony Douglas, don't miss that, and Earl Davis of BMO as the potential risk for rates very much front and focus ahead of that Fed meeting. This is Bloomberg Surveillance. Good morning.
You have concerns about growth, you have geopolitical concerns, and the latter pushing some safe haven demands.
The risk here for markets is whether or not there's an escalation.
Frankly, I think markets might have sniffed some of this out.
This is exactly the kind of opportunities that you want to buy.
There are lots of opportunities for investors. They're just not looking in the right place.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance, where our heads are spinning to start the week. The fourth day of a conflict still ongoing between Iran and Israel. Questions around trade partnerships as President Trump heads to Canada for G7 meetings. And oh yeah, it's Fed week. That's right, where the central bank will be putting out projections as they sit in a dark room with blindfolds on and try to figure out the state of the economy. John is off for the week. Danny Berger, we're very lucky to say, is stepping in for the next 2 hours. Danny, it is striking that amid all of this risk roulette, and that's all I can call it, Markets pretty quiet this morning and trying to feel positive.
Is it quiet? Is it positivity? Or is it complacency? I think that's the big question to ask. Trading ranges have been so narrow, even heading into the escalation of the conflict. Now oil is lower. Now stocks are higher. It's not even a hot war. It's also, as you say, I think it's 40% of the world's economy will have central bank decisions this week. It's a bond auction today. It is the G7. There's so much event risk. And here we are just quietly trotting along.
And it really goes to what Steve Ricchiuto was talking about earlier, just a glut of liquidity and a sense that this has been a resilient economy. And yet one thing that's interesting is, we haven't even mentioned this, that we've got retail sales tomorrow. I mean, all of these indicators that we normally would be parsing through, how much is the consumer falling off at a time where there are signs that the labor market truly is starting to weaken?
Or how much are they just starting to become immune to the back and forth? The University of Michigan sentiment survey on Friday showing an improvement for the first time in 6 months. Is it much like investors? They just see the back and forth between trade. They see another geopolitical conflict, and they start to get numb to it.
And right now what we're seeing in markets is that numbness, or at least a bit of a rally. Equity markets, S&P futures up about 0.5% earlier, retraced a little bit of that. Up now just about, same thing, about 0.5%. And NASDAQ futures up more. What you're seeing in the bond space, yields up for a second straight session. They were rising even on Friday in the face of geopolitical risk, really raising a question of the response function for this haven asset. And crude prices lower after rising 7% on Friday as people take a look at the likelihood of some sort of disruption and or not as the conflict does remain between Iran and Israel. Coming up this hour, don't miss this, Dan Skelly of Morgan Stanley Wealth Management as stocks try to rebound. Henrietta Treyz of Veda Partners as the Senate debates President Trump's tax bill, and Earl Davis of BMO as inflation concerns resurface ahead of that Fed decision. We begin this hour with our top story. Israel and Iran exchanging attacks for a fourth day with no signs of easing. Joining us now, Annmarie Hordern from the G7 meetings in Canada and Jumana Bersetchi in Dubai. Jumana, I want to start with you. What's the latest in terms of the back and forth between Iran and Israel?
Yeah, no signs really of things letting up over the course of the weekend. In fact, we've seen an intensification of strikes from both sides between Iran and Israel. The latest being that Israel, over the course of the weekend, targeted over 80 different targets within Iran, be they military, defense. This morning, the Israeli military say that they've taken 1/3 of Iran's surface-to-surface missile launchers out, so 1/3 of their capabilities from the defense side, in addition to strategic targets on nuclear sites as well, one of them being Isfahan, a key part of the uranium enrichment process in terms of making the feedstock that's necessary for the enrichment process. So very targeted, but then also the death count has continued to climb. The Iranian Health Ministry putting out the latest figures at 224, of which about 6 of them are senior IRGC commanders and several dozen of nuclear scientists as well, key to the nuclear know-how. As for on the Israeli side, Iran have fired what the Israeli military has said is north of 350 ballistic missiles towards central Israel and northern Israel, also including 100 drones. Most of them have been intercepted, but what we've seen in the last 24 hours is there actually have been several of those missiles that managed to penetrate Israel's air defense system, causing damage. The death toll in Israel also rising, the latest figure being 24, with some damage being sustained to buildings as well. But no real signs of de-escalation at this point. And if anything, the war of words, the rhetoric, has increased. The Israeli Prime Minister saying that they will continue to target all of those sites, strike at every site and every target of the Ayatollah regime. The Iranian side saying that they will hit back unless Israel decides to de-escalate and stop their attacks on Iran. One thing I would say for markets, though, is so far we're avoiding the worst case scenario of this spreading out into a regional conflict. It has been bilateral. There hasn't been a closure of the Strait of Hormuz. No infrastructure, key energy infrastructure has been hit. And of course, U.S. assets have also been spared. But the longer this takes on for, of course, the more probability there is for this to get more broad and for the broader regions to get involved.
Annmarie, meanwhile, over in Canada, what's the international response and how much is the U.S.'s response in the focus right now at a time when there already are fraught relations?
Well, it's going to overshadow the G7, and frankly, it already has. These partners are going to be meeting here, and they're supposed to be speaking about trade, especially when you have the likes of the European Union, Japan here. Mexico's president is here. She wants to get in the room with the president, as well as Prime Minister, the host country, Mark Carney, to discuss U.S., Canada, Mexico trade. But what's going on in the region, this conflict between Israel and Iran, and Israel's strikes on Iran, is definitely overshadowing this G7, especially when it comes to the U.S. response and what that response might be. We know that the United States at this point has not joined the offensive. And the president, though, said to ABC News that it is, quote, possible that they would get involved. We do know, of course, that the United States is part of the defense of Israel and in the region. A key question when it comes to if the United States was going to get involved, would it be in trying to attack these nuclear sites that experts have long held, like Fordo, that are incredibly challenging for Israel, and they wouldn't be able to do it alone. There was one moment, though, Lisa, over the weekend, some reporting, a U.S. official telling us here at Bloomberg that the president did discourage and veto an Israeli plan when the Israelis said they had the opportunity of taking out the supreme leader, Ayatollah Ali Khamenei. So that is one moment where we did see the U.S. have restraint. But this will completely overshadow the G7. Lots of concerns about this becoming a regional conflict, what it means for shipping in the region, as well as the price of oil that can impact all of these economies. So this is going to be the focus. I'm not sure, though, you're going to get a statement of unity.
Annmarie, Jumana, both of you, thank you so much for that wonderful reporting. Here's a view on Wall Street. Dan Skelly of Morgan Stanley writing, if the conflict in the Middle East escalates, higher crude prices could push out the Fed's timeline to cutting and put downward pressure on consumer wallets. At the same time, the tariffs are impacting goods prices. Dan, trying to parse through all of this, joins us now. Dan, thank you so much for being here.
Good morning.
Do you feel like markets are being overly complacent at a time where you're seeing pressure on the consumer in various ways with the potential added shock of some sort of oil price spike?
Absolutely, Lisa. And so I think the key word is complacency, as Danny alluded to earlier. And, I think it's mostly a Mag 7 story. We saw a big rebound in NASDAQ and Mag 7 over the last 6 or 7 weeks. If I look further underneath the surface at the ratio of cyclicals to defensives, at gold to equities, or at small caps to large caps, those cohorts are telling you a very different story. They're all trading near their April lows, and they're saying that growth is more concerning going forward, which we tend to agree with.
And the Fed's going to have to be parsing through that, and we'll get there in a second. There is this question, though, RBC put out saying that stocks risk a potential 20% drop if there is some sort of high inflation type of scenario on the back of some sort of oil disruption. Do you agree that there could be this kind of bear market should there be some sort of escalation in the Middle East along with the inflation from the tariffs?
So 2 things, Lisa. First, I think a retest of the bear market close to 5,000 is unlikely. We've already seen the flexibility of a White House pivot, number one. Number two, as I just referenced, tech is in a much better place today than it was a year ago, and the market is sniffing out an AI adoption cycle for the rest of the market earnings picture as well. So we don't see us going back to the lows, but we do have to keep an eye on the Middle East. I would say offsetting the Middle East concern at the moment is 2 things. First, Israel has hit close to 300 targets, but very consciously avoiding hitting the key oil infrastructure. And that's why I think oil is giving back a little bit today. And then second, let's think about where OPEC supply was going into this event. They were obviously bringing on more production, so that helps maybe absorb some of the geopolitical risk factor in oil today.
Should anything be priced in, though, Dan? Because it is a market that's learned time and time again that geopolitical issues raise and they flare up. They get priced in for a moment, and then we rally again. Is there any reason to suggest that we shouldn't be treating this conflict the same way in terms of how an equity market, how risk markets might react?
So excellent point, Danny, and I would concur. This event, this scenario should be similar to previous events. I think the fact that the White House is already trying to de-escalate and talk down the situation and look to negotiate is key to that. But with all things, geopolitics, earnings, tariffs, this is a year to adapt, and forecasts have been less relevant.
Well, to your point, part of the adoption is adoption of AI. To what extent is that, do you see that saving the market? That if there is growth concern, if there is pressure on margins starting to come in, that AI is going to come in and save the day for many industries?
Yes, so look, that's the key question for the fundamental parts of the market, which have been somewhat lacking for the better part of the last week or so. But look, number one, Mag 7 wore this really unique hat as the biggest spender and the initial biggest beneficiary of AI. You're starting to see that broaden out within technology across software monetization and consumer internet. But the key question, back to your point, Danny, is when does it hit the rest of the Fortune 100, the financials, the healthcare sector, the industrials? We think that moment's going to come closer to 2026. So to answer your question, it doesn't save the market this year. We avoided the sell in May, but we're still fearful of a summer swoon. And the reason for which is we consider the tariff situation completely unsettled. Only something like 10% of companies in the S&P took tariffs into their guides in 1Q. No one has any clue as to what the picture looks like for the rest of this year.
How important is it whether the Fed looks through it and still sees this as a short-lived or short-lived, as they say, inflationary shock versus something more sustained that would cause them to keep rates higher for longer?
So that's a key question, Lisa, and I think the Fed is very much looking at it, as many of the economists at Morgan Stanley, as a one-off event. We're feeling that the tariff-related hit takes inflation back above 3%, closer to 3.5% towards the end of this year. But it's very much a one-off event that gets settled and really realized this year and starts to move forward next year.
Do you get the sense that markets disagree, given the fact that bonds haven't provided the haven type of status that they have in the past two trading sessions, when we are worried about what's happening in the Middle East? Does that raise a question about the markets pushing back about this being really short-lived versus something much more prolonged?
So that's a fair point, but I would argue the markets are also focused on fiscal. And this idea that we're going to have probably by the end of July more clarity related to the big, beautiful bill. And look, the Senate version of this is likely to add another $1 trillion onto the deficit. And so I think the bond market is not just feeling out traditional safe haven status, but also thinking about fiscal expansion going forward.
Dan Skelly of Morgan Stanley Wealth Management. You'll be sticking with us. And honestly, all I can say, Danny, when we talk about the big, beautiful bill, when we talk about the trade, when we talk about G7, it sort of feels like, where are we? Head spinning, just given the fact that the narrative just changes every single day.
It's so true. And we are looking forward to the Fed decision for their summary of economic positions. If companies don't know how to react, to Dan's point, only 10% have started to incorporate tariffs. What is the Fed going to do? Are we going to be putting too much into what they're saying for the future when, let's be honest, they don't know, nobody knows?
And probably that press conference will be uncertainty, 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 very uncertain. Right now, let's get you an update on some more certain stories elsewhere this morning. Here is your Bloomberg Brief with Yahira on it. Yahira.
Hi, Lisa. President Trump says he believes Israel and Iran could eventually reach a peace agreement. Speaking to reporters before leaving for the G7 summit, he said the two countries may have to continue their conflict before coming to the negotiating table. In an earlier interview on ABC Sunday, Trump said U.S. involvement in the conflict is possible. Meanwhile, California is urging a federal appeals court to maintain a lower court's order limiting the Trump administration's use of National Guard troops in Los Angeles. Lawyers for California argue that allowing the administration to continue directing troops in the city would escalate tensions and increase the risk of violence. The legal fight follows days of unrest amid protests against President Trump's immigration raids. And another activist investor is seeking changes at Victoria's Secret. Two sources telling us here at Bloomberg that Barrington Capital Group, which has built a stake in the lingerie retailer, plans to push for a board overhaul. Earlier this month, one of Victoria's Secret's largest investors, BVRC International, also called for major board changes. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Coming up next, Trump calling for a deal.
Well, I hope there's going to be a deal. I think it's time for a deal, and we'll see what happens. But sometimes they have to fight it out. But we're going to see what happens. I think there's a good chance there'll be a deal.
He was talking about Iran and Israel. He could have also been talking about the big, beautiful bill. He could have also been talking about some of the trade negotiations. Henrietta Treyz of Veda Partners joins us coming up next. This is Bloomberg Surveillance. Markets are trying to figure out what to focus on and how much to care. Right now, geopolitics, as Danny was pointing out, not necessarily weighing as much on stocks because they've been punished every time they do care. So stocks are starting to rally just a bit to start the week, up about 0.5%. In the dollar space, continuing the weakening trend, almost 116, 115.79 on the euro dollar, and 10-year yields higher ahead of that 20-year auction later today, as well as the Fed meeting that starts tomorrow and ends with a rate decision on Wednesday. Keynote, they will not raise rates. They will not lower rates for 43%. Under surveillance this morning, Trump calling for a deal.
Well, I hope there's going to be a deal. I think it's time for a deal, and we'll see what happens. But sometimes they have to fight it out. But we're going to see what happens. I think there's a good chance there'll be a deal.
Here's the latest. Fighting between Israel and Iran continuing for a fourth day. Neither side showing signs of de-escalation. At least 23 people have been killed in Israel and more than 220 in Iran. The conflict will be at the forefront of talks at the G7 summit kicking off in Canada today. Bloomberg's Tyler Kendall joins us now. And Tyler, we were just saying, let's make a deal could be for absolutely anything, whether it's between Israel and Iran, whether it's between trade partners. How much is the White House able to keep track of all of the potential agendas that it has going right now at a time when they are very key for markets and, frankly, for what a lot of people see as the global trajectory for trade relationships going forward?
Yeah, hey, Lisa, there was a lot of moving parts here that the White House is contending with as the G7 summit really does kick off. And of course, the White House had been wanting this summit to really be focused on trying to make some of those trade deals come to fruition as we now are within the less than a month mark from that July 9th deadline. And it's clear the administration wants to show forward progress, particularly as we see some of these other allies start to make their own deals between themselves. We know Canada and the United Kingdom, for example, are going to talk on the sidelines about how they can shore up their economies against President Trump's tariff threats. But at the end of the day, the ongoing conflict now in the Middle East really is going to take center stage. And perhaps it will be a binding way for these countries to move forward together, since we know that Israel is calling on both the U.S. as well as European allies to assist them when it does come to the offensive part of their operation. For example, we had the Israeli science minister over the weekend saying that those allies really should come together to assist Israel. But it's worth pointing out, Lisa, that over the weekend, President Trump didn't have a call with a G7 partner. He had a call with Vladimir Putin of Russia, who, of course, is a strategic ally of Iran, in bidding to try to mediate these talks going forward. So no doubt there's a lot of different tricky areas here that this White House is going to have to contend with as they kick off this week.
Tyler Kendall, great work. Thank you so much for that. Joining us now, Henrietta Treyz of Veda Partners. And Henrietta, I want to go to that point. How much does, and this is something that Kelsey Berro was saying earlier, how much does the eruption of conflict between Iran and Israel distract the White House from some of the other measures that it was working on, in particular issues with trade negotiations as well as the tax bill?
You know, it's not just the White House. It's also Republicans in Congress. I've been with leaders of the Republican Party for the last couple of weeks, most recently in London. And one of the things that I keep remembering is that they called on Trump. And the reason that they support him at their core is that he's a stabilizing force. And they were referencing the uptick in war between Russia and Ukraine. And to think that now this has evolved into Israel and Iran when President Trump was actively trying not to have this occur really cuts to the center of that argument and proves that it's not accurate. The president's going to continue to try to solve for peace there, but saying, you know, they maybe just need to fight it out is certainly not a stabilizing force as people assess, you know, is this going to escalate or not? I think what it does is it puts attention back on members of Congress to get down to brass tacks and finish this bill. My expectation is that they will be successful. It's going to take another month, though. The senators are going to pass their legislation by the end of probably next weekend into the 4th of July recess. But we're still going to have a long way to go to square the House bill versus the Senate bill, which are at least $1.3 trillion off from one another right now.
Henrietta, this is also a president that had campaigned and touted once he was in office, keeping energy prices low. The threat of higher oil, of higher energy prices, how much does that color what the Trump administration, how they approach Iran and Israel?
Yeah, this is a critical point, and it really hits to the ability of the president to escalate the tariffs that he has pending, you know, massive increases, 50% for some nations, more than that, in less than a month. I think that the point the administration makes over and over and over again is that low gas prices versus 2023 or 2024 is worth $200 to the American consumer and the average household. It masks or blunts the negative $3,200 hit from the tariffs. So having gas prices rise limits the president across a whole host of sectors, both in terms of being able to make cuts to pass the tax bill, which will cost, $4 or $5 trillion, and they need to cut from federal savings programs, Medicaid, federal safety programs, Medicaid, SNAP, et cetera. When you have higher gas prices, that becomes more difficult. And it also decreases the president's maneuverability to impose sanctions on Russia, for example, or secondary sanctions on China and Iran, which we know members are chomping at the bit for the president to do. But again, back to that destabilizing force, instead of stabilizing, he's not willing to sanction Russia and is instead calling Putin when Israel invades or attacks Iran to have them help negotiate a peace. So we're definitely very concerned on oil prices right now.
Henrietta, just from a very practical standpoint, we had talked a lot about the idea of reaching trade agreements with so many different partners in 90 days itself was complicated. If you add in a hot war, you add in the talks that have been going on with high-level partners, rather high-level cabinet officials, rather than those lower down. Just how difficult will it be in the coming days to reach agreements with partners, with this also on the mind of the White House?
Yeah, and I think it's important to maybe migrate away from thinking about agreements as opposed to short-term punts and deals that allow the president to push out July 9th into the future, into September, October, November. The base case that I have for tariffs is, as you've been mentioning all morning, there will be sectoral tariffs. That is the goal of the administration, to ultimately move away from IEEPA into Section 301 and 232. So pharmas, lumber, copper, semiconductors, all those pieces are on deck for higher tariff rates. So if you're an analyst exposed to those sectors, you need to be up to speed on what 232 and 301 are right now, because those tariffs will come for the remainder of Trump's second term. And then when you think about the short-term deals that he's going to try to reach to delay the Liberation Day tariff rates, what we're seeing is a mixed bag. We're going to get higher tariffs on Vietnam. We could be seeing higher tariffs on Nicaragua, Indonesia, Malaysia, and very specific countries that we have long-standing problems with, whether that's transshipping or human rights, in which there's already Section 301 investigations launched, and we can more narrowly target our tariffs towards them. And then there are going to be other nations like the UK, hopefully Japan and South Korea, where we haven't reached a broad deal yet. India, for example, is going to have a three-pronged, phased-in negotiation process that very likely will take years. China obviously will take years. So some of these tariff rates are going to be paused where they are. I don't know of any that are going to come off. The sectoral tariffs on Mexico on steel and aluminum may come down from 50% to 25%, but that's as far as we're going to go. So net tariffs are rising, not lowering.
Henrietta Treyz of Veda Partners, thank you so much for that. Dan Skelly, we were joking about how it feels like when you enter too many commands into a computer and it just says, I'm buffering. It feels a little bit like how we all get the sense every morning when we wake up. How do you figure out what to focus on?
So I think the buffering year is a perfect metaphor for what's going on. Listen, I think as it relates to our key clients, you have to stay focused on their objectives and their goals, which is longer term compounding, risk-adjusted outlook. And so, look, within the broader market, we're saying have some safe haven in terms of gold, have some alternative assets that give you some better risk-adjusted outlook in terms of hedge funds and other privates. You can't be complacent in terms of the index level outlook.
I heard that Costco sold out of their gold bars, but I'll look for other places. Dan Skelly, thank you so much for being with us of Morgan Stanley. Coming up next, we'll take you to the Paris Air Show, where Bloomberg's Guy Johnson has an interview with Riyadh Air CEO Tony Douglas next. Don't miss that. This is Bloomberg Surveillance. Markets looking to retrace some of the losses from Friday. Good morning. Even as the conflict between Iran and Israel enters its fourth day, the market's trying to game out worst-case scenarios and seeing potential upsides for maybe not an off-ramp, but not necessarily a broadening out of the conflict, with futures up about 50 basis points for the S&P, 2 hours away from the cash open. Here is your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Roku. Those shares are up nearly 10% now on news announced that it's teaming up with Amazon to build a new connected TV ad platform. It'll launch later this year and cover major apps like Prime Video and the Roku channel, reaching about 80 million U.S. households. So at a time when cable viewership is declining, this move shows how streaming is becoming the new battleground for TV advertising. Next up, we have CoreWeave stock down, actually up about 0.7% now after B of A cut its rating to neutral. Analysts say that with the shares up 145% since Q1 results, any near-term gains are likely priced in. But interestingly, they did raise their price target on the stock, pointing to strong signs like that reported deal with Google and OpenAI, which was announced last week. And last up, we have Victoria's Secret shares. Those are up 3.3% on hopes that change could help turn things around for the struggling lingerie company. That's because another activist investor is knocking on the door. This time it's Baring Capital, which has built a stake in Victoria's Secret and wants changes on the board and overall strategy at a time when it's being pressured by major competitors, by Skims, which we all know is owned by none other than Kim Kardashian. Lisa.
Thank you so much, Yahira. We'll be watching that closely, I'm sure. On our radar this morning, the conflict between Israel and Iran entering its fourth day. Iran firing drones and missiles overnight. Israel claiming it targeted military bases with airstrikes. President Trump says the two countries may need to fight it out before reaching a deal, Danny.
Well, it is a market that certainly sees a more optimistic outcome. But is that wrong? I was speaking with Bob McNally of Rakuten Energy earlier today, who has advised many presidents on various regional conflicts, saying that Iran's only card they have to play right now is to hurt their energy output, is to do something in the Strait of Hormuz, because the president of the United States is deadly afraid of oil in the triple digits. Iran can't win a conventional war with the U.S., so maybe what they need to do is play that card to force the U.S.'s hand to say, you need to come in and help with negotiations to get Israel to back off, or else we will be backed into a corner and we will have to do something.
I just was struck by the idea that oil prices rose 7% on Friday. They rose at one point as much as, I believe, 14%. There was a real feeling that maybe this could be a real sea change in the region. Now they're trying to decline just a touch, but there is a feeling that even if it is a short-lived kind of disruption, this is going to affect supplies, and it is going to affect the region. I just wonder how we parse that into inflation at a time where that's been the tailwind for so many consumers.
And inflation, when it comes to energy-driven inflation, that is the kind of thing that does tend to be transitory. So is it a Fed that, confronted with that, needs to look through it? I mean, I doubt they'll say transitory again, ever again, perhaps, but that is typically what happens when you get those energy shocks.
Should be an interesting meeting later this week. Meanwhile, President Trump arriving at the G7 summit in Canada for the first major international gathering of his second term. More than a dozen world leaders are expected to look to strike trade deals with the United States. The group will also address the escalating Middle East crisis that we've just been talking about, and a real question here about also the trade deals that are on the table. I mean, honestly, how do they come together with any sort of cohesion at a time of so much dissonance?
Well, in 2018 at the G7, when Trump was there, the last one he attended, there was a huge rift. He basically called for the nations to not set aside Russia as severely as they had. Ties since then between the G7 leaders, you could argue that they've only gotten worse because of the trade deals. Where can you see agreement? Not just on trade, on Ukraine, on what's happening in the Middle East. There is a lot for these various leaders to try to parse through. I don't know how they're going to get it done.
There was a quote that Max Bergman of the Center for Strategic and International Studies had, and it was in the New York Times, saying this: the previous G7 summits, as well as NATO summits, were sort of awkward family gatherings. The question now, I think, is not so much, is this an awkward family gathering? I think the question is this still a family? And this really brings us to this question of how are other countries dealing with fissures in the G7? Chinese President Xi is in Kazakhstan to meet with leaders of Central Asian countries. A key focus for the gathering is reported to be future-proofing China's economy for a potential rift with the U.S. by strengthening ties with the resource-rich region. I believe Kazakhstan provides about 40% of the uranium globally, but it really points to this question of how the global global world order is completely changing.
Yeah, and look, it's no mistake it's Kazakhstan that she tends to visit the most. For one, again, the resources are very important in a resource-rich nation, but also this is kind of the land bridge between Asia and Europe, and that's another place that we've seen the closening of ties. Ursula von der Leyen went to China, Giorgia Meloni went there just last month. So you also see Europe maybe looking at China in a different way because of the push from the United States. And again, Central Asia plays an important role in that.
Well, let's head to Europe right now, to the Paris Air Show, where Bloomberg's Guy Johnson is joined by a special guest. Guy, thanks so much.
Lisa, thank you very much indeed. Yeah, welcome to the Paris Air Show, the 55th Paris Air Show. And all the subjects you've just been talking about are very much on the agenda here. I'm joined by Tony Douglas, the CEO of Riyadh Air, one of Saudi's new airlines that is coming to fruition over the next few years. You just placed a big order for Airbus A350s. You're a big buyer of Boeing aircraft as well. We've obviously just been talking about what's been happening with the crash that's happened in India, and also what's been happening in the Middle East recently in terms of the conflict between Israel and Iran. Let's start off with the latter. How big a problem is it for regional airlines currently to be operating? You've operated in the region for a number of years. Airspace in this area is getting smaller and smaller and smaller. Do you think this is a permanent feature of the landscape?
Look, our part of the world has always been very dynamic, and recent events have yet again illustrated that. It's deeply disturbing, and of course, airlines, as usual, have to make sensible contingent measures. So route changes, a new phenomena in other parts of the world, have actually been around quite regularly in our part of the world. And as you mentioned, I've been in the region for quite a long time, and hopefully this conflict, we hope and we pray, will come to a conclusion very, very quickly in a peaceful way, and we can get back to normality.
Let's talk about what's just happened in India. You're a buyer of, you haven't got them yet, but you are a buyer of the 87, the Boeing 787. You're still confident in the aircraft?
We're 100% confident in the aircraft. We placed an order for 72 787 Dreamliners back in March of 2023. Obviously, what's happened in India is shocking, and our condolences go to everybody who's been affected by this horrible affair. Far too early for anybody to speculate. Obviously, the process will determine what root cause was, and when that becomes apparent, everybody will act upon it. But at this stage, there's no change in status on 787.
You've also, here at the air show, just a few minutes ago, ordered a load of Airbus aircraft as well, Airbus A350s, the competitor to the 87. Is there any pressure on Saudi Airlines, given the politics at the moment, to lean more heavily towards Boeing? Or is it a purely commercial decision on which you're making these big purchases?
Yeah. It's a purely commercial decision, and perhaps if I explained what we've done earlier today, we placed an order for 50 A350-1000, so an incredible aircraft. That's 25 fixed and 25 options, and we'll probably have a configuration around 360 seats with an incredible first-class product in the aircraft as well. So that will be our flagship airframe. In October of last year, we placed an order for 60 A321neos, and one of them's here on the apron in our resplendent Riyadh livery. And before that, it was 72 Boeing 787 Dreamliners. Again, there's one of them here in our incredible livery today. That's 182 aircraft ordered in 2.5 years. The brand is Riyadh, and if ever there was a demonstration of the intent and how important this is to have a new capital carrier, it couldn't be bigger than that.
Are you worried that all those aircraft may not be delivered? There's tariffs coming in. You've got supply chain bottleneck issues potentially being caused by those tariffs as well. I spoke to Larry Culp of GE the other day. He's talking about price rises coming through for engines as well. There seems to be a multitude of complicating factors coming through at the moment. Is it getting more complicated to buy aircraft, set up an airline? do the things that you're trying to do at the moment, how much are these other factors complicating some of that process?
So are there lots of complexities out there? The answer, of course, is yes, there are.
Are they getting more complex, though? I guess is the question.
In some places they are, and in some places they're getting easier. So where I was 2.5 years ago, I was clearly 2.5 years further back than where we are today. In 787s, there's 4 of them going down the production line now of final assembly in Charleston, South Carolina, as we speak. And you can probably imagine that gives a gentleman like me a warmer heart and an awful lot of excitement and confidence as we see these aircraft going from a configuration plan into hard build. And we start taking deliveries of 321neos this time next year as well. So for us, exciting times. Will it ever be easy? Of course it won't. But is it, and that's why we love aviation.
But is it getting more complex? You've got all kinds of other factors coming into the fore to the fore at the moment. Are there issues with you importing aircraft? Are there issues exporting aircraft? The euro-dollar rate is changing dramatically at the moment. Aircraft are priced in dollars. I'm hearing 120, I'm hearing 130, I'm hearing 140 in terms of the price of euro-dollar. Now, Saudi obviously is a different case in terms of the way that the currency is managed. I'm just kind of wondering, have some of the factors that you started off dealing with 2.5 years ago changed in terms of the factors you're dealing with now?
Well, I'll probably draw a slightly different parallel first, and that is pre-pandemic. We had oil prices over $100 a barrel, which of course is the number one cost in commercial aviation.
Could be going back there again.
And we had ticket yields at an all-time low in 30 years in relative terms. So in those days, it was actually difficult making any money in commercial aviation. Here we are post-pandemic, where ticket prices have obviously now increased significantly in terms of yield, and oil prices, notwithstanding what's happened in the last week or so, have come down significantly, and we've seen lots of airlines now posting big profits in recent times. So in one sense, the commercial landscape has eased, but the world of other complexities, of course, has continued to stack layer and layer of challenges on there. And guess what? It's pretty much always been that way, one way or the other. The trick is play what's in front of you and also embrace ambiguity, because it's an ever-present in commercial aviation. The things that have happened that you've referred to earlier over the last 3 weeks ago, 4 weeks ago, nobody imagined.
Yep.
It's the way it is.
Tony, great to see you. Thanks very much indeed for stopping by. Congratulations on the order. Tony Douglas, the CEO of Riyadh. Guys in New York, back to you.
Guy Johnson there from the Paris Air Show. Thank you so much. Great work as always. And what really stood out to me, Danny, was just how much there is this feeling of resilience. When you talk to corporate executives, they say, look, we've got to look long term. We always deal with uncertainties. We've been trained by the pandemic, and this speaks to the resilience that we've been hearing about and seeing right now in markets.
I was going to say, how many executives are just saying we got through the pandemic, so surely we can get through this? But also, how many executives looked at their peers, mentioned something about the tariffs and a worst case scenario and saw their shares get crushed and say, maybe we shouldn't be talking about that right now?
Yeah, on the flip side, of course, there is that, of course, the reality of maybe don't game out the worst case scenario. But there's also a feeling, particularly for airlines, that lower oil prices were met with the incredible consumer demand. And now you have potentially higher oil prices, but demand is still going to be resilient. I mean, they've dealt with so many uncertainties that kind of balance each other out at the end of the day. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anna and Yahira.
Hi, Lisa. Multiple cities in the U.S. saw protests opposing President Donald Trump as he held a military parade on his 79th birthday. Nationwide demonstrations displayed the banner of No Kings to denounce what they say are Trump's authoritarian tendencies. The protests were largely peaceful but saw sporadic violence, including a shooting in Salt Lake City. Meanwhile, Southwest Airlines is adding a new cockpit alert system to help its pilots avoid dangerous situations. The Wall Street Journal reporting the cockpit alerts are similar to warning systems in modern cars that detect other cars in blind spots or if a driver is about to back into another vehicle. This comes after the carrier experienced a number of close calls in U.S. airports in recent years. And JJ Spaun won the U.S. Open on an unforgettable walk-off putt on the 72nd hole at Oakmont. After falling behind on Sunday with 5 bogeys in 6 holes, Spaun stayed focused and sunk the 64-foot putt for the win. He finished 1 under 279 and was the sole golfer to finish under par at one of the world's most difficult golf courses. The win marks Spawn's first ever major championship. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. And somewhere Jonathan Ferro, while he is on his vacation, is watching that game. And I'm sure very excited, of course, on this set. Probably neither of us are particularly.
No. It was on in the background in Casa Burger, but was I paying attention to it? I regret to say I was not.
And this maybe is a reason why. Up next, uncertainty clouding the Fed's path.
We have seen some speculation that the Fed may not be able to cut rates as much as had been anticipated recently. I think what's going to happen is the market is going to hold steady and just kind of wait and see where this is going.
Earl Davis of BMO joining us next as we take a look at the dual competition for the Fed between slowing growth and potentially higher hits to inflation. It's a calmer market heading into this week, but it has not retraced the losses that we saw on Friday. We are staging something of a rebound. S&P futures up about 0.6%. They were down well more than 1% on Friday in the face of escalating Iran and Israeli tensions and conflict. The euro dollar is seeing ongoing weakening of the dollar. We're seeing 115.71. The dollar weakening once again. 10-year yields higher and continuing to climb, now up about 4 basis points, 4.44%. And this really is the question. How does the Fed deal with dueling rules, given the fact that you've got inflation and the concerns about the oil prices, as well as potential deterioration in the economy? Under surveillance this morning, uncertainty clouding the Fed's path.
We have seen some speculation that the Fed may not be able to cut rates as much as had been anticipated recently. And on the other side of that equation, obviously, you have concerns about growth, you have geopolitical concerns, and the latter pushing some safe haven demand. So that's kind of what's happening in the U.S. Treasury market. There's a push and pull there. I think what's going to happen is the market is going to hold steady and just kind of wait and see where this is going.
Here's the latest. War in the Middle East and rising energy prices complicating the outlook for the Fed. Earl Davis of BMO writing, although oil prices increases are immediately inflationary, it is a consumption tax on growth, the perfect environment for stagflation. Earl joins us now. Earl, thank you so much for being with us. Welcome. Good morning. There is a feeling that this does complicate the equation for the Fed at a time when, yes, longer term, you could see some sort of deceleration to growth, but in the short term, this is only going to exacerbate the month-over-month comps, if nothing else, for the inflation reads.
Yeah, it complicates it from an explanatory perspective in case they did want to ease. Now you can't use inflation, or at least I wouldn't say the lack thereof, but consistent inflation as opposed to rising inflation as a reason to ease. How it does, in my mind, make it a little bit easier, I think it puts a high amount of focus on the unemployment rate. From our perspective as an active manager, what we're looking at, and right now we don't anticipate any eases from the Fed this year, but one thing we are looking at is the unemployment rate. If that hits 4.5 or above, I do think that that allows them to ease. So that's the thing that we're focused on now in this environment.
And there is a question of continuing claims rising to the highest since 2021, and whether that's sort of a forward-leading indicator that that is going to happen. You are going to see that increase. Just how high is the bar, though, for the Fed to cut rates, given the fact that inflation potentially could resurge on the heels of tariffs and oil prices? Is that enough, a 4.5% unemployment rate, even if inflation is not back to their 2% goal for a sustained period of time?
Well, the interesting thing is the bar is not actually the numbers on the economic data. The bar is time. Given that Powell's term is coming up, do we see those numbers before his end of the term? It's our take that, if we were to see a 4.5 unemployment rate, it's not till late Q4, early Q1 2025. So we see more the bar is time, and then all things change depending on who the new Fed governor would be.
Well, Earl, just given that, the uncertainty around global conflicts, around trade, the fact that in 2026 we won't have Powell at the helm of the Fed, how much value can we put in the SEP at this point?
That's a great question. I'm going to rephrase my answer from the perspective of fixed income and risk assets. Like, how much do you buy riskier assets? How much value do you put in? I think we're in a well-defined, you have to look at two things. What's the range? And then where are the tails? So we're in a well-defined range in regards to, it's going to be very difficult to make 10% higher new highs and easier to make 10% lower new lows from today. So that says the bias is towards the downside. There is still a good economy happening in the U.S. underlying it. So you don't want to be short, but you do want to get a bit more defensive. And you do want to ensure that you're in liquid risk assets, something that you can liquidate in case that left-hand tail, which is a worst-case scenario, is realized, which is not our base case. So how we're looking at it, it's a range trading environment, and I look at it from fixed income. If you look at U.S. 10-year treasuries, you buy U.S. 10-year treasuries between a yield of 4.5%, 4.75%, and you sell it between a yield of 4.25% and 4%. From becoming safer, you stay away from 30-year bonds. There's too much price risk with that. We don't mind duration, but it's limited to those levels and 10-year treasuries.
Could the front end, though, also be vulnerable, Earl, from a Wednesday decision where last time we got the summary of economic projections, it was a 2.8% core PCE they saw for 2025. Is there a risk that that moves meaningfully above 3% and then that forces a repricing of the front end?
No, again, we see the tail towards higher yields or less discounting of eases, right? So it could move higher, I think, because of where inflation is now. That reduces that downside risk, that pricing with a 3 handle. But the front end will be stable. We're seeing a lot of money go into the front end from, as people reduce the amount of risk they have. So it'll be supportive, but we don't see a meaningful repricing coming to the downside anytime shortly.
Earl, did it bother you on Friday when we saw a risk-off move in equities? We saw oil prices surge and you saw bonds sell off, the traditional haven asset not performing as such?
Yes, it did bother me. There's two reasons why people own fixed income. One is for the coupon, and that's where you go into corporate bonds, you get a higher yield. But the one is for capital appreciation, exactly what you said, those risk-off moments. We feel it's still there, but it's very level dependent. So it did disappoint us. We went more underweight treasuries after we saw that. But between 450 and if we come close to 475, you definitely want to buy. And the reason why you definitely want to buy is what we saw in last week's 10-year and 30-year bond auctions was increased participation by foreigners, which are usually foreign governments. So we know there is support on the upside, and that's where the value comes from risk off. You have to buy it at those levels, not at these levels.
Earl Davis of BMO Global Asset Management, thank you so much. Really interesting, especially ahead of that 20-year auction later today, $13 billion of 20-year bonds being sold at 1 p.m. Eastern at a time when there's really question about where the marginal buyer is going to come from, Danny.
Well, it was last month, this very same auction, that you did see a tail that concerned the market. And it led to these fears starting that maybe we're going to get a buyer strike or at least a foreign buyer strike. As Earl was kind of mentioning, the thing that is helping us out is the 10 and 30-year auctions last week went off fine. There was plenty of demand. But things have changed since then, as they do seem to change really quickly. So maybe we have a rethink of it.
It's so interesting. People say that when they talk to some of the foreign asset managers, they all say they want to really hedge some of their dollar exposure, move away from the U.S. And then you ask how many of them are actually selling, and it's a little quieter. It's not necessarily that clear who's selling right now.
It's true. Sometimes it is very painful to bet against the U.S. It hasn't always worked out. It has so far to start the year, but it's a painful trade to try to take.
Coming up, we're going to be speaking with Cameron Dawson of NewEdge Wealth, Ellen Wald of the Atlantic Council, Jonathan Pingle of UBS, and Amanda Lynam of BlackRock. This is Bloomberg Surveillance.
It's very hard to see the U.S. walking away from Israel if the Iranians are mounting a massive counterattack.
This White House has been consistent. They do want to see a diplomatic approach.
A tremendous amount of damage has been done to Iran's ability to respond.
We'll have to kind of wait and see what that situation in the Middle East plays out.
You're more likely going to see people fade those geopolitical risk events rather than double down on them.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. It's Fed Week and Bank of Japan, Bank of England and Riksbank Week. Central banks around the world grappling with the inflationary shocks and potential hits to growth. There are trade fissures. And now we have the fourth day of Israel-Iran conflict, possibly disrupting oil supplies. John is off this week. Danny Berger is joining me for the next hour and throughout the week. And Danny, I mean, it just strikes me. This is like a central banker's nightmare as we face off with a potential hit to growth at the same time that people are worried about a disruption to oil supply that could cause prices to surge.
This is the remarkable thing. The last time we got projections from the Fed was their March 19th meeting, and so much has changed since then. The world has changed, trade has changed, geopolitical tensions have changed. But will the Fed be changing their tune? They might very well still adopt this wait-and-see approach because it's a hard time to have high conviction in anything, especially for the Fed right now.
Meanwhile, we do have a host of economic data in this shortened week. Thursday is a holiday in the United States. Tomorrow we do get retail sales, which a lot of people used to watch. We get jobless claims a day early on Wednesday, as we also do get that Fed decision. Everyone's minds are completely distracted because we're watching what's going on in Israel, in Iran, and trying to understand what this actually means for oil prices, what this actually means for some of the trade negotiations that are going on with G7. I mean, how do we get our hands around how exactly we focus our minds on which item to watch?
Well, that might be the problem. Lori Calvasine of RBC was talking about this over the weekend in a note, basically saying we're already coming from a really fragile place, that we're already really hamstrung by uncertainty around tariffs. You add in Israel, Iran, what does that do to sentiment when you see valuations really stretched? If you do have an inflation uptick, you mentioned this earlier, she says that she could see stocks falling some 20%.
Yeah, and this partly comes because valuations have been really elevated. Right now, that is not the case in any way, shape, or form after Friday's sell-off, and it wasn't a massive one. You are seeing a retracement with stocks futures near their session highs, up 0.6% on the S&P. You're seeing dollar weakness yet again. The euro gaining versus the dollar, 115.72. And this, to me, is possibly the most interesting of all of the moves, and that is an ongoing sell-off in the 10-year note. You're seeing 4.45%, up 5 basis points in terms of yield ahead of a 20-year auction later today, even as crude prices are lower. And this is a retracement of what we saw from the spike, the 7% spike on Friday. Crude prices down 1.2%. Coming up this hour, Cameron Dawson of NewEdge Wealth. As traders react to the latest strikes between Israel and Iran. Ellen Wald of the Atlantic Council on the shock to energy markets, and Amanda Lynam of BlackRock as inflation fears resurface for the Federal Reserve. But first, we begin this hour with our top story. Attacks between Israel and Iran entering a fourth day with no signs of any kind of off-ramp. Annmarie Hordern is following President Donald Trump and joins us now from the G7 in Canada. Annmarie, you're in a fantastic position to understand the sort of collective response from this group of 7 nations at a time when there are myriad challenges, both with Israel and Iran, as well as with trade relations.
Well, exactly, Lisa. Israel, Iran, this conflict that many G7 leaders, all of them are really concerned that this could become a wider regional conflict, is now overtaking the agenda items that were set for the G7, notably when it comes to trade negotiations with the United States, as well as trying to find a solution when it comes to Ukraine, given the fact that President Zelensky is here. So now you have the issue of Iran and Israel top of mind for all of these leaders, especially since the United States, we know, was given a heads up about this, and the United States is coming to the defense of Israel. They are just not involved in the conflict offensively. But the president left the door open. Speaking to ABC News over the weekend, he said, "We are not involved at this moment, but it is possible." He also said to reporters before he came to Canada, leaving the White House, that these two need to fight it out, and then I think at the end there could be a deal. Potentially what the president wants to do is see a weakened Iran without immediate access to potentially build a bomb come to the negotiating table. But it's anyone's guess how long potentially this may take and when the U.S. or if the U.S. may actually get involved, especially if they think they could take out the nuclear capabilities at the center of Fordo, which is buried deep into a mountain. We should note there was one moment of restraint we saw from the United States on the Israelis over the weekend, and that is a U.S. official confirming to Bloomberg that President Trump did veto the Israelis when they said they had this opportunity potentially take out the Ayatollah.
Annmarie, great work. Look forward to catching up with you throughout the week as you are on the ground there from a beautiful Banff, Canada. Here is the view from Wall Street. Cameron Dawson of NewEdge Wealth writing, it's all about oil. If prices are contained, markets will move on. But if prices begin to drift higher, this could throw a wrench in both the economy and markets. Cameron joins us now. Cameron, after a very restful weekend, thank you so much for being here. So here's a question. Are markets being overly complacent to the risk that there could be some sort of oil shock, or are they being realistic? The geopolitics tends to be not that lasting.
Well, it really all does depend on oil. If oil prices change their trend from being in a downtrend over the course of the last 3 years to start to trend higher, this is when this turns from being a contained geopolitical risk to being something that will have a more lasting impact on markets. So if we take the objective look of just looking at the oil technicals, it's overbought in a downtrend at resistance. Usually that would cause you to want to fade the move, and maybe that's some of what we're seeing this morning. But because we're dealing with exogenous shocks, we have to be very attuned and aware that if oil starts to trend higher, this is a big issue for inflation readings. It hamstrings the Fed, and it causes pressure on the consumer, all things that this equity market would not like.
How much can you act on that now? How much can you seek out hedges? Because in the past, when we've tried to trade geopolitical conflicts, it fades out pretty quickly.
We think this is exactly why you need to have some energy exposure within equity portfolios, because it hedges against a risk that nothing else in the market does very well, which is why when we own energy stocks, we're trying to own the highest quality parts of that market, but we're not owning them for necessarily distinct upside, but to be able to have something that can zig when the rest of the market is zagging in the event of geopolitical events, exactly like what we're seeing.
Elsewhere, though, you have started to see sentiment improve, despite the fact that we still have tariffs, we don't have more agreements, and now another and intensifying hot war between Israel and Iran. Does the sentiment uptick in general make sense to you?
Yeah, we wrote a note over the weekend inspired by tools saying that we don't want to become victims of our own certainty. And there certainly seems to be a fair amount of certainty that it's come back into this market as you've seen sentiment really chase the 20% rally higher. Now, there's certain pockets of positioning that still are light, which suggests to us that the pain trade overall still could be higher, but we think you're bumping up against a resistance of a ceiling on valuations. We're trading at 22 times earnings. That's a half a turn lower than the peak that we got back at the end of 2024. That was the peak of American exceptionalism. And to your point earlier, a lot has changed since that point that calls into question that exceptionalism and that ability to trade at such a fulsome valuation. So we don't think that we're priced for any kind of risk or downside, which just means that expect more volatility if the headlines come.
Risk and downturn and potential downside is sort of in the eye of the beholder. What is that risk, right? Is it the risk of inflation and a reacceleration of growth, some sort of stagflation, some sort of disinflationary shock? And I say this at a time you say about valuations remaining in question really goes to the heart of the rate picture. And the fact that you did not see a bid into long bonds on Friday at the same time that you saw a risk-off move, how much does that alone truly threaten and undermine some of the valuations that seem pretty elevated here?
The 10-year Treasury yield on Friday was Sherlock Holmes' dog who didn't bark. It was so peculiar to see, as you're having this risk-off move throughout the rest of the world, that duration around the globe did not do well. And that's because of exactly what you said on stagflation. When there is an inflation overlay to a potential growth scare, duration does not do well. We learned that lesson in 2022. And so that is what we think is the key risk here, is that your typical safe havens don't do well if you do see an uptick in inflation, which brings you back to why oil is so very important.
Because if oil prices go up, that just speaks even more to the stagflationary shock. It's sort of telling that this week we have so many central banks. I think Danny put it at 40% of the world's central banks coming out with decisions. Imagine making a decision at a time where you're in a dark room with a blindfold bumping into chairs. But there's a real question here about where they weigh the risk more heavily. Do they see, I don't want to use the word transitory, but a short-lived inflation risk when it comes to both trade as well as with respect to oil, or do they have to weigh that more seriously with also some of what we've seen in the terms of the hangover from the pandemic?
If we think about their two mandates, if we think about the labor side first, it's not bad enough to get them to act. meaning that you're not seeing enough employment weakness, you're not seeing enough growth weakness overall to get them to move and push inflation to the side. And because inflation still has such a big question mark about where it will trend through the rest of the year, because of oil, because of tariffs, they don't have the reason to act now. So it just says to us that they will continue to sit on their hands. They'll continue to say we're being patient, and Powell will probably say that he will continue to wait for clarity. But clarity probably is the scarcest asset of any asset that we can find right now.
Well, I'm sure we'll still dig through the SEP to see where the dots are, to see what their inflation and unemployment projections are, to get some sort of signal. Should we be putting less value in it, just given what you're saying?
Yeah, because it very much is a shot in the dark. And I would be looking at the growth line. So it was at 2.1% in December. They marked it down to 1.7% in March. But consensus right now for 2025 real GDP is at 1.4%. So if they move their GDP estimate lower, Powell is going to get questioned to say, why aren't you talking about more rate cuts if you're cutting growth estimates even further? Then you'll have to compare that to the inflation forecast. And will they actually mark that lower? Because inflation has come in shock to the downside, or surprise to the downside year to date. So then you'll have a scenario where they could be marking down inflation and growth and yet not doing anything to rates because the forward outlook is so uncertain.
So are you buying gold bars or Bitcoin?
Well, I do think that when we think about safe havens, gold proved to be a better safe haven on Friday than Bitcoin did. And we think the reason for that is that inflation overlay and what that means for global liquidity. If inflation is higher, that suggests that central banks have to be tighter, which means you're constraining liquidity. Bitcoin needs ample liquidity. So in a high inflation, kind of uncertain growth environment, gold, we think, wins over Bitcoin. And gold is probably one of the best charts in the market right now. Super powerful uptrend.
Yeah, we've seen that record high again and again. Cameron Dawson of NewEdge, thank you so much for being with us this morning. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. President Trump appears to be doubling down on his mass deportation policy. In a Truth Social post last night, he called on ICE agents to expand deportations in the largest U.S. cities, including Los Angeles, New York, and Chicago. Last week, though, Trump acknowledged the impact his policies have had on rural communities and promised changes to protect farm and hotel workers. And this just in, President Donald Trump registered his name for a mobile phone service. The request made with the U.S. Patent and Trademark Office would cover mobile phones, cases, battery chargers, and wireless telephone services, and possibly retail stores. The filings suggest plans could be in the works for a Trump-branded mobile phone or service to compete with Verizon, AT&T, and T-Mobile. And LA Dodgers phenom Shohei Ohtani will make his return to the mound tonight against the San Diego Padres. The two-way superstar hasn't pitched since the 2023 season when he played for the Angels, taking nearly 2 years to recover from surgery. As a batter, his 25 home runs rank first in the National League. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. I got to say, the idea of a mobile phone service under Donald Trump's registration wasn't on my bingo card this morning.
It wasn't, but, neither were gold shoes that he sells. You need the whole kit, your phone, your shoes, your hat, good to go.
All right. Well, coming up, we've got, of course, discussions more with not only the morning calls, plus Ellen Wald will be joining us of the Atlantic Council on the risks to energy markets, as we were just talking about with Cameron Dawson. It's all about energy right now. Crude prices just off a touch after surging 7% on Friday. This is Bloomberg Surveillance. Coming into Monday with a better tone than Friday when there was a risk-off sentiment and surging oil prices. Oil prices lower this morning, and you are seeing stock futures up across the board, up almost 0.7% now at near session highs at the S&P. You're seeing that not really take place in the bond space. Yet another day of a sell-off with yields touching 4.44% and higher, going up 5 basis points. A question ahead of that 20-year auction later this morning. Time now for the morning calls. First up, TD Cowen upgrading to Celsius Holdings to buy, citing improved sales growth and the acquisition of energy drink company Alani Nu. Next up, Cisco upgraded to buy at Deutsche Bank. The analyst noting AI tailwinds and supply chain positives, helping the company navigate tariffs. And finally, Citi raising its price target on Mattel. The firm saying that the toy maker and other leisure stocks have bounced back as worst-case scenarios of tariff risks have been taken off the table. We're seeing Mattel shares unchanged as people grapple with just what the tariffs could mean for Barbies. Back to our top story for markets, a fourth day of fighting between Israel and Iran, raising uncertainty for energy markets. Ellen Wald of the Atlantic Council writing, if Israel can take out Iran's ability to produce gasoline, diesel, and provide electricity, the situation becomes significantly more dire. If the regime cannot maintain control through the use of force, it will likely fall. Ellen joins us now. Ellen, thank you so much for being with us. And we are just getting word from the Prime Minister, Benjamin Netanyahu, that Israel is on the way to destroying Iran's nuclear and missile threats. Do you have a sense, Ellen, of what the end game could possibly be?
You know, it's interesting because I think for Israel, the real end game is just to take out all of the Iran's ability to threaten them. So the missile sites, the nuclear sites, I don't think that they're really aiming for regime change. I mean, they don't want to participate in that. I think that there's also the understanding amongst them and also amongst U.S. policymakers that what would take its place. And sometimes a lack of a regime or a power vacuum could be even more dangerous. I mean, there's the IRGC is probably the strongest entity in Iran. And so if, the civil government falls, it's possible the IRGC or what's left of it would take over, seeing that they have, control of most of the use of force there. And that could be, potentially a worse situation than they're in now. So I think there's a very delicate balance here between causing, widespread destruction. If you're going to take out, multiple fueling stations and you're going to take out multiple refineries, then you're going to essentially, send Iran to the dark ages for a period of time. And things could really fall apart at the individual and city level. So I think that they're really, working more towards taking out the military capabilities as opposed to trying to, foment widespread destruction.
Ellen, a lot of people have talked about the idea of some sort of broadening out of the conflict and embroiling a greater number of countries in the region in this war. I just wonder, who's Iran's friend? Why is there anyone coming to Iran's defense in any capacity? Or are more of the nations on Israel's side or just frankly don't want to get involved in any way, shape or form?
So I think that in terms of, friends, I think that Iran has potentially has maybe some strategic allies that could be useful in maybe arguing Iran's case in a diplomatic situation. So take China, for example. China buys a lot of oil from Iran, or relatively. They're Iran's largest customer. But because Iran buys that oil and they accept Chinese currency, they have to spend a lot of that Chinese currency on goods and services from China. So China does a lot of business in Iran. And China doesn't want to see this situation fall apart. If, in fact, it gets so dire that there are threats to Chinese ships or oil tankers that are heading for China, coming out of the Persian Gulf. And that's not just Iranian ships. That could also be ships coming from Saudi Arabia, from Kuwait, from other oil suppliers. Then China is definitely going to exert the full weight of its economic might internationally and on Iran and say, okay, you've got to cut a deal. This has to end. This is not worth threatening our, economic relationship. Russia, likewise. In fact, we saw Russia saying now, hey, we're ready to, facilitate negotiations and we'll accept all of your uranium, Iran, which, is kind of an interesting offer from Russia. But they're definitely, I wouldn't say they're necessarily on Iran's side. They're not going to come aid them in the event of military catastrophe, but they would definitely be there to support them in a diplomatic sense. And I also think, you've got Saudi Arabia. The Saudis definitely aren't best friends with the Iranians, but relations have certainly improved. And I think the fact that you see them essentially quiet is really almost a sign of not support. They definitely would they're more than happy for Israel to take out Iran's nuclear arsenal and nuclear reactors, but they don't want to see Iran completely devastated. That's not a good situation for them. Like a power vacuum in the Gulf is not going to be a good situation for the Saudis or for the Emiratis or for anyone else. So if it gets to that, you are going to see them standing up and I think trying to support the regime.
Ellen, whenever conflicts arise in the Middle East, concentration quickly goes to the Strait of Hormuz and the likelihood of it being closed. Is that the right thing to be concerned about? Or is there a scenario where you get what's happening in the Red Sea, where you get a few tankers attacked, and that's enough to convince insurance companies that it is not worth trying to insure ships going through the strait?
So it's interesting. I think there are 2 points there. I do think that we're a bit stuck in this old paradigm from the 20th century where we all, as in the West, need oil from the Persian Gulf. And we all remember, or at least those of us who were alive, then remember the Iran-Iraq war, and there was the tanker war, and both sides Iran was trying to prevent certain tankers from leaving the Gulf, and certain tankers needed basically U.S. military escorts in order to get out, and that caused havoc with oil prices. So I do think the Strait of Hormuz is a very important waterway, but if you look at the traffic patterns and the way that ships go around there are other ways to traverse the straits that don't involve going through Iranian waters. So if Iran did threaten the security of ships there are workarounds. They're not that easy and would take some time to work through, but it is absolutely possible. The other issue, though, is that like you said, that can Iran actually do this? It's not clear that they could physically close the straits. On the other hand, they could cause enough trouble that insurance companies are going to raise their rates through the roof. Now, does that make it impossible for ships to go? No. People will pay, but oil prices will have to go up. Customers will have to pay more in order to compensate for that insurance rate. When you look at the Red Sea, that's a little bit different because there is an alternative route. You can go around Africa, and a lot of large ships are equipped to do that. So, but with the Strait of Hormuz and the Persian Gulf, other than a couple pipelines that are able to get oil and other products out without going through the straits, there really is no other way out. So for Iraq, Kuwait, some Saudi oil, Bahraini oil, there's no other way. The UAE has a workaround, and so modifications could be made, but there's nothing else they can do. So they're going to just have to pay the higher insurance rates.
Ellen Wald of the Atlantic Council, thank you so much, as always, for your insights. And Danny, I'm struck by some of the shipping costs, which have been surging on the heels of this increased risk, because why would anyone take this on unless they had better insurance, as well as potentially longer routes that are going to be more expensive?
It's so true. Ellen makes a really great point there that a large percent of ships going through the Red Sea already faced really high insurance costs. So they did other routes. There is no large scale alternative for the Persian Gulf. So if that is what we see, you see insurers backing out, you could really get some disruption to oil prices, even though it's not an outright closing of the Strait of Hormuz.
Which is a reason why there is a feeling that right now there isn't going to be a full retracement of that 7% boost surge that we saw on Friday to oil prices, that you could see that persist. And even though you are seeing a bit of a decline this morning, it hasn't retraced that because of some of these potential risks. Coming up, Jonathan Pingle of UBS, as we do remember that, yes, Wednesday is the Fed decision. And of course, there are central banks around the world which are grappling with all of these risks that frankly make an already cloudy picture that much more uncertain. This is Bloomberg Surveillance. It's an uncomfortable calm about an hour before the U.S. Open. We are seeing equity futures do continue to gain near session highs, 0.7% now at session highs on the S&P, up 0.9% on those tech darlings, the NASDAQ 100 futures higher as people look at what's going on with AI. Crude prices lower just a touch after last Friday's surge on the back of the Iran-Israeli conflict. 1 hour away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. It was a bit quiet this morning, but now we have a flurry of movers, and we start with Archer Aviation. Those shares are up 4.8% after the CEO spoke with our own Guy Johnson over at the Paris Air Show. And the CEO told Guy that defense sales could outpace Archer's air taxi business for now. That's because he says military demand is soaring at a time when passenger flights are taking a bit more time for the company to scale. Meanwhile, we have shares of Insight. Those shares are up 8.9% here after trial results for its experimental blood cancer drug came in strong. In a small study, over 80% of high-risk patients saw a complete response with no major safety issues reported, and that spurred an upgrade by analysts over at Stifel. And we end with some more pharma news. This one related to Sage Therapeutics, up 36% now after Supernus agreed to buy the company for up to $12 a share. And if the deal goes through, Supernus would gain Sage's FDA-approved Zurzuvae, a pill used to treat postpartum depression. I was waiting for some M&A news to make this an M&A Monday, and it looks like we got it. Lisa?
Thank you so much, Yahaira. We did get some as people look past the geopolitics. Meanwhile, we do have a busy week of data ahead, including a Federal Reserve interest rate decision. Bloomberg's Michael McKee joins us now as some of the gatherings begin in Washington tomorrow.
Yes, Lisa, and it is maybe the calm before the storm. I like what you said about the calm in the markets ahead of the open because we're waiting on a lot of data and the Fed to make some news. We got the first data of the week, the Empire survey from New York manufacturers. The New York Fed puts that out, and it shows a decline in the overall number down to negative 16 from 6. New orders also declined and general business conditions fell. Shipments also down. But the interesting thing there is that prices paid fell. Prices charged rose. So make of that what you will as we get ready for the Fed. Retail sales tomorrow is going to be the highlight of the week, along with perhaps jobless claims on Wednesday, because Thursday is a holiday, so we move it up one day. Retail sales expected to rise, shows Americans still spending, but the question is by how much? And then, of course, we get the Fed meeting on Wednesday. What are they going to do for the dot plot? What are they going to do for the summary of economic projections? You heard Cameron Dawson talking about what if they raise both or cut both the unemployment numbers and the inflation numbers. How do they defend what they're doing or not doing? It's going to be a very interesting Wednesday. And then we have to note that by the end of the week, the Fed will be done for the month until the end of July. But the tariffs news comes back the first week of July. So we're going to have a half-life on all this stuff.
Yeah, especially because there's this ultimate question. When do you actually get certainty at a time where they're saying they're waiting and seeing? What are they waiting for? What do they hope to see? Michael McKee, thank you so much for being with us. Right now, Jonathan Pingle of UBS looking ahead to Wednesday's Fed decision, writing, we expect no change in policy. In a press conference still enveloped by uncertainty. However, we expect the summary of economic projections to be relatively hawkish. Jonathan joins us now. Jonathan, can you elaborate on that? What does it mean to be hawkish at a time when we are starting to see some weakening in the labor market?
Well, the FOMC is, I think, starting to see some weakening in the labor market, but I think the data has been just good enough that they can sound relatively hawkish and prioritize inflation for the time being. And I think that's what we're going to get in the summary of economic projections. I think, yes, everything is quite uncertain. And I also think that these discussions over how to weigh labor market weakness against tariff-related inflation are only just beginning, but I do think that this is a meeting where it's at least going to look like the FOMC is prioritizing inflation over the labor market.
How do you determine, Jonathan, their scenario analysis if you do get some sort of challenge to their dual mandate? If you get a rise in an unemployment rate at the same time that you have inflationary shocks that some people could argue would be short-lived or transitory or whatever kind of word that people hate to describe it, how do you understand what is bad enough to get them back in the rate-cutting game?
Yeah, I mean, I think you sort of hit the nail on the head, Lisa, with exactly something that I think they're only really just starting to grapple with. And I think this SEP, where they actually have to write down, what the tariffs might imply for inflation, what the weakness in demand might mean for the unemployment rate, that they're really going to start now, I think, grappling with this trade-off. But I think to your point, Lisa, one of the things I think that's going to really trouble the committee is they don't have the right tool for the job. I mean, the funds rate is not It's an aggregate demand tool. It's not going to stop the tariff cost push inflation, but it does risk making the labor market even weaker. So I think these are conversations that they're really just going to start to have now as they weigh what they might do when the mandate goals come into tension. But I also think that when they really are in tension, there could be many other things that start to weigh on their decisions, such as risk management, and really what tools do they have to address that problem.
What about the weight of Chair Powell no longer being the chair, Jonathan? If we start to really see the impact come next year, what happens if it's not Powell at the helm, but someone else who maybe has a more dovish bend per the request of President Trump?
Well, that's a bridge we'll have to cross when we get there, Danny. I mean, that's a great question. But, for the next 6 months, this is probably Chair Powell's, sort of car to drive. And he has been in the driver's seat with this FOMC. Next year, I think there's going to be a little bit more clarity over what the actual impacts are, what the second round effects might be, what the actual labor market looks like, and whether it's anyone on sort of the short list we've all been talking about, how they want to weigh the unemployment rate and inflation is going to be up to them. But also we shouldn't forget, I mean, this is a committee. I mean, the chairs might be in the driver's seat, but they're not unilaterally ruling over the committee.
Fair enough, Jonathan. Well, in the more short term, what we have seen recently is some of the sentiment measures start to pick up. There's been a lot of criticism of them that they're overly political, don't pay attention to the deterioration. Should we start to pay attention to things like the University of Michigan sentiment survey start to turn around?
Well, I think watching some of these sentiment indicators is useful for understanding what's going on. But we've certainly seen, financial markets, weighed upon by the April 2nd announcement and having rebounded since then. But I think one of the interesting things is that some of the hard data actually looks like it's starting to soften here. I mean, if I look at the number of people collecting unemployment insurance benefits, continuing claims, we'll get another read on Wednesday. That's sort of taken another leg higher in a worrisome way. I'm sort of curious what happens when we see the next orders and shipments data, capital goods orders. If you stripped out aircraft and defense in April, they didn't look that strong. So I think it's important to watch the sentiment indicators, but I also think that, we're at a juncture where it looks like some of the hard data could be weakening here as well.
There's a real question here, Jonathan, why the long end of the yield curve hasn't rallied more as a result. A lot of people think that inflation isn't going to be run away. You even see that in some of the surveys. Some of the inflationary fears have been coming off, albeit some of those surveys were taken before the potential oil shock. We were speaking with Jeffrey Gundlach of DoubleLine in California last week, and he said you're already starting to see the loss of U.S. exceptionalism in the sense of people being concerned about the fiscal backdrop, in the sense that you're not seeing a rally into treasuries, and that if the Fed were to cut now, they would actually see a sell-off in the long end. Do you agree with that? Do you think that there is this concern that the Fed has lost control over the long end of the yield curve?
So I don't know so much if the Fed has lost control of the long end, Lisa, but we have had, some of these episodes of periodic concerns around supply. I mean, we've seen term premium moving around with refunding announcements. There has been a certain different price action around, concerns over the supply of U.S. duration, which at the moment is probably not being helped by the budget debate on Capitol Hill. We'll have to see. Our rate strategists generally think that, at high frequency, if the economic outlook gets really bad, that the cyclical tends to dominate the structural. But we are looking at a pretty dire debt outlook, and we have seen these periods in the bond market where, supply concerns have started to, periodically assert themselves.
So, Jonathan, there's this other question, too, especially if the bill gets passed, the one big, beautiful bill in Washington, D.C., whether that's going to be stimulative and that's going to potentially create an upside risk to growth, which would be beneficial in offsetting some of the deficit and would also potentially bolster the inflationary outlook. How realistic do you think that is?
Well, I mean, looking at what the House passed, we do think that is going to be somewhat stimulative in 2026 with some spillover to 2027. We'll have to see what comes out of the Senate and what changes are made. What the House did is it front loads actually a lot of the stimulative components of the bill and then sort of backloads a lot of the phase outs and pay-fors. So we would score that as a modest boost to 2026. But it's sort of an interesting timing problem because the tariff effects we have in our forecast, they're coming sooner. Then it's followed by this boost from fiscal policy. So it's going to be, I think, potentially quite a volatile next year and a half as we see, sort of these two forces play out. Now, we don't think this is a super boomy growth impetus coming out of the bill. We scored sort of, 0.4 of GDP growth to come as a boost to 26 and 27. Could be more. These estimates are highly uncertain. We'll see what we get out of the Senate. So this is nothing like what we saw come out of the Biden administration in terms of the stimulative effects. But, our guess is it's going to be a modest tailwind for 2026 growth.
If that's your timeline for the big, beautiful bill and when it impacts growth, Jonathan, what's your timeline for when we finally see the impact of tariffs and what that means when we'll finally see some live Fed meetings?
Yeah, well, we're expecting to see the impact of tariffs really start to mount as we go through July and August. We had been writing for some time that we didn't really think the tariffs would really impact the data very much through the May data. And it's really sort of now as we look ahead to June, July, August, where we think, the pass-through in prices starts to like seep in and escalate and mount. And we really think the Fed meeting is when we have a rate cut, because we think by then, yes, they will be looking at the tariff-related inflation, but I think we're going to be looking at a soggier-looking labor market. And I think, unlike last year where the growth scare was kind of concentrated in a few indicators, I think there's going to be a broad swath of indicators that look weak and worrisomely weak as the Fed heads into the September FOMC meeting.
Jonathan Pingle of UBS, thank you so much for the insights. And as we try to parse through all the uncertainty, and Danny, you asked the right question, which is essentially, when do we stop waiting and seeing and actually see? And the answer is later.
Yeah, it seems like September seems to be one of the things we're coalescing around. Steve Englander of Standard Charter writing this morning that we could have a Fed that this week guides that we could get 50 basis points of cuts by September, that they want to give themselves optionality on the dovish side, too. I got to say, we're hearing from Jonathan there, from others, that make it sound like the Fed might be more towards the hawkish side, not that dovish side of things.
Trying to control the idea of inflation expectations at a time where that is the most recent error that they want to avoid doing again. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anna. And Yahira.
Hi, Lisa. Fighting between Israel and Iran is now in its fourth day. Just this hour, Israeli Prime Minister Benjamin Netanyahu spoke from an Air Force base and said its Air Force now controls the skies over Tehran. He also said Israel is on the way to achieving its two goals in the campaign, which is eliminating Iran's nuclear and missile threat. Meanwhile, the man suspected of killing Minnesota Democratic state lawmaker Melissa Hortman and her husband, Mark, is in custody. The FBI had offered a $50,000 reward for information leading to the arrest of 57-year-old Vance L. Bolcher. Two other people, including a state senator, were injured in Saturday's shooting. And George Russell won the Canadian Grand Prix for Mercedes in a dramatic finish in Montreal, beating Max Verstappen by 0.2 of a second. After the race, Red Bull filed an appeal against the win, alleging safety car infringements. After a review that lasted 5 hours, stewards rejected Red Bull's claims and validated Russell's win. It marks the fourth career race win for Russell. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira, and thank you for this morning. Up next, setting you up for the week ahead. Plus, Amanda Lynam of BlackRock will be joining us as we look at whether this market is being overly complacent about some of the dueling risks. This is Bloomberg Surveillance. About 43 minutes ahead of the opening bell in the United States, we're looking right now at markets that are climbing a wall of worry. S&P futures up 0.7%. The gains really concentrated actually in the small caps as people look to possibly reprieve from some of the most extreme risks in the oil market. Russell 2000 up 1.1%. In the bond space, and this is important, you are seeing a sell-off ongoing ahead of that 20-year auction later today and ahead of the Fed meeting that begins tomorrow and ends on Wednesday, 4.43% on the 10-year, as we look to wonder how much this is an inflationary risk and how much this is something they can look through. Counting down to the opening bell, here is the trading diary for the week ahead. Today, the G7 summit underway in Canada. Tuesday, retail sales, don't miss those. And a Bank of Japan rate decision. Wednesday, jobless claims plus a Federal Reserve rate decision and Chair Powell news conference. On Thursday, U.S. markets are closed for the federal Juneteenth holiday, and we'll get another rate decision from the Bank of England. The Fed's two-day meeting kicking off tomorrow. Joining us now is Amanda Lynam of BlackRock. Amanda, a difficult time for the Federal Reserve to be meeting, given that their dueling risks seem to be, their double mandate seems to be very much increasingly in conflict. Do you think we're going to learn anything at all this week?
Right. Good morning. Thank you for having me. That's the one thing that we are focused on. I would say the summary of economic projections has the potential to give us some incremental clarity on their reaction function. We think on the margin it will reflect a more challenging growth inflation mix. But keep in mind, this is just the median of all of the different committee members. It's not actually a cohesive projection from the committee. So we need to kind of discount that. What we are most focused on is what would be the scenario analysis, the reaction function, if the dual mandate comes into tension. A few months ago, you started to see Chair Powell, Beth Hammack talk about that being on the radar. I think the incremental news, it has become, as you alluded to, even more challenging with the geopolitical situation. So that would be hopefully the one nugget that we will be looking for is how would they navigate that backdrop? What would they prioritize? The SEP already reflects an unemployment rate of 4.4% for this year. So we know that they are baking in some weakening in the labor market. How much weakening would we need to see in order for their posture to change?
Earlier this year, there was a feeling that any inflationary shock from tariffs or trade tensions in general would be transitory. They even used that word, or even short-lived. Now there's a question of the dual shocks. You have the tariff risk, and then you also have potentially some sort of oil shock that is persistent. Even if it's not the closure of the Strait of Hormuz, there is this feeling that there's going to be a higher premium. How much does that complicate things and create a more sort of long-lasting inflationary impulse?
I think you nailed it. It's not just the inflation data, but inflation expectations. So even though they're navigating to core PCE, which would exclude energy, if we do have a rise in oil prices that is sustained, does that alter inflation expectations for consumers, and could that cause them to react? I would say there's kind of twofold impacts that we see from this geopolitical backdrop. It's one, should there be higher risk premiums on corporate credit? And then two, are there actually sector-specific implications if there are sustained supply chain disruptions? We haven't seen that yet. Hopefully we don't. But those are really what we're focused on. And then the magnitude and the duration of that has yet to be seen. Even when the Fed was, I would say, casually using the word transitory, when was that? Back in the March meeting. It was also caveated with a healthy dose of we're not quite sure really where this is going. I remember that meeting very well. And so I think they're even hesitant to say that they'll be able to look through it. I think they're just raising the possibility that maybe they can look through it.
Well, to the point of credit markets, again, it's another thing where we see spreads widen a little bit and then not really react that much, where you have seen some weaknesses in the junkiest part of the market. Is the risk real there? Could you start to see defaults pick up in that area?
Sure. So two things I would say. Our conversations, and really since early May, have focused on two-sided risks, exactly as you noted. Widening episodes have been short-lived, and actually the common refrain from a lot of investors is, oh, I wish I would have taken advantage of that more. So that's a very real risk, and so we're very focused on the two-sided risks. Where we are trading carefully and have been are those kind of left tail pockets of the market that were already under pressure before the economic data deteriorated. So, for example, U.S. CCCs had interest coverage below 1x already last quarter. It's rebounded a bit. That was before the economic data deteriorated. You see that in pockets of the leveraged loan market. You see it in pockets of private credit. So that's really where we need to focus, is saying, okay, let's not be too defensive. There's a real opportunity cost to being under risked, but at the same time, if a company was already having trouble growing into its capital structure, or a sector was already having trouble navigating this environment, nothing on the horizon is going to make it easier. And so that's really, I think, where we are mindful. I will add, though, the high yield and leveraged loan default rates have been quietly creeping for the past year and a half, and it has not derailed the performance of the speculative grade parts of the market. So I think what that's telling you is it's the smallest capital structures that are defaulting. It's oftentimes repeat defaulters, and that is by definition priced into the market.
Well, if we do see a Fed that falls in between that dual mandate and they can't take action and they can't cut and rates do remain elevated, does that start to spread?
Well, actually, somewhat counterintuitively, it's probably going to support the yield-based bid for corporate credit, which has been a really powerful technical force. I would say the yield-based buyer has exhibited some patience on and off, so they're sitting it out sometimes. But in general, structurally higher interest rates coupled with okay growth, even below trend growth, that's not a bad recipe for corporate credit. That would probably bring some of that yield-based demand in off the sidelines. This is also part of the reason why we like selectively moving down in quality. You were talking about the volatility in the treasury market. Kind of one of the understated differences between IG and high yield is a shorter duration market. So you're kind of less exposed to those swings in treasuries, especially at the long end.
Just real quickly here, is the private credit market exposed to forced selling based on the fact that you're seeing endowments of universities looking to raise money?
Not forced selling. Illiquidity is a feature, not a bug of private credit. What I think that is reflective of is a multitude of factors. And I think it's a positive that actually folks can make asset allocation shifts over time when they need to with illiquid assets. But it's not a liquid market by design.
Amanda Lynam of BlackRock, thank you so much for being with us, as always. Turning now back to our top story, leaders gathering at the G7 summit as Israel and Iran enter a fourth day of conflict. Bloomberg's Annmarie Hordern joins us now. Annmarie, what's coming up today? What's on your horizon?
Well, just in about 2 hours' time, the president will kick off his first bilateral meeting here in Canada. That will be with the host country, the Prime Minister, Mark Carney. Remember, Lisa, there's a lot of memories from the last time Canada hosted the G7. There was that viral photo of the president sitting in a chair, kind of defiant with his arms crossed, looking up at Angela Merkel, then German Chancellor, a number of host leaders around her as well. And then he left and said that he didn't want to sign the communique, which is why going into this meeting, don't expect all of these leaders to agree on a number of issues. So a number of statements will not get a G7 unified voice. And Iran and Israel could be one of them. The war in Ukraine, another one, as well as climate change.
Yeah, and a real question of what the bilateral discussions will look like. Annmarie, I know that you're maybe going to go hiking later, like I would, because it looks really beautiful. Annmarie, thank you so much joining us from Banff, Canada, from the G7. Love to see that, but I am curious to see some of those bilaterals, how much the equation is changing as you look to potentially other relationships that are tightening in lieu of some sort of more global G7 one.
And so many big issues they need to work through. Zelensky's going to be there, so there's the issue of Ukraine, Russia. There's the newly brewing issue of Israel and Iran, and there's all the trade disputes. Where are we going to see any cohesion in any communiques we get? Where are we going to see any deals, any agreements? It looks very challenged right now.
And it's difficult to know how they focus on one issue when there are so many. It's the whack-a-mole of topics that we've been talking about of 2025. Coming up tomorrow, Chris Verone of Strategas, Krishna Guha of Evercore ISI, Alicia Levine of BNY Wealth, and Nadia Lovell of UBS as that Federal Reserve meeting kicks off with a lack of clarity across the board, a fourth day of conflict between Iran and Israel with real questions about trade, about geopolitics, and about the economy. This is Bloomberg.